Lloyd is down 14%.
Sure.
With their $428,000 retirement plan.
Aren't they associated with the same thing, which is ultimately the long securities underwater if you bought it 3 years ago and you sat on it?
The 3 years is the key phrase there. It's not the move or the level, it's the timeline, it's the x-axis.
Down something like 50 to 60%, and have we fully realised the pain associated with those losses at the long end? We've seen some of it come to the surface in the banking industry in the spring, and maybe more is still to come. Your market looks like this morning on the S&P. Enjoyed the run, TK. Futures unchanged on the S&P 500.
Thursday run.
Yields up. I disagree. About what? I'm not sure. Up 4 basis points.
Financial.
495.77 on a 10-year. Bramo, the euro, 105.54.
Over in the financial world in Wall Street, 8:30 a.m. we get U.S. initial jobless claims, and at 10 a.m. we get existing home sales. Do we get a tick up in the number of jobless filings? Today we do get a host of Fed speak from a host of different banks. We get Chicago, Atlanta, Philadelphia, Dallas. We hold a whole host, but the real main event is Fed Chair Jay Powell, who's going to be having a conversation with David Weston at the New York Economic Club today at noon. And at 8 p.m., President Biden is addressing the nation, and this really is one of the biggest mysteries. He's going to talk about potentially $100 billion in additional aid to help fuel some of the efforts by Israel and by Ukraine. Is the fiscal part of this a significant proportion of the increase in yields? And if so, this is going to be a longer-term problem that takes the conversation, John, away from the Fed and very much to the fundamental fiscal policymakers in Washington, D.C.
The president addressing the nation a little bit later on this evening. Let's address the airlines right now. New outlook for American Airlines. Here's the outlook now. Full-year adjusted EPS, here's the range, $2.25 to $2.50. Previous range, $3 to $3.75. The estimate, $2.34. The stock is down by 1.4%. The airline stocks have been absolute dogs since July. It's been brutal, Bramo. Some of these names are down like 20, 30%.
American are down 39.
Yeah, but this to me is going to be an issue of how they really deal with the potential of increasing oil prices. And then all of a sudden disruptions. If we do get real disruptions in travel, we saw United really point to that with respect to flights to Israel.
Do you see Delta?
I did.
Changing their air miles rewards program all over again.
They got pushback from people who were medallion holders that they raised the bar a little bit too far.
Did you write it in?
I did not write in. I'm not going to use my
position
ever to influence anything.
I would never.
Of course not. You would. American Airlines down about 1%. Cameron Dawson with us, CIO at New Edge Wealth. Cameron, good morning.
Good morning.
Let's talk about the struggle for those airlines at the moment. Is that just one sector? Does that tell you something about consumer discretionary spending more broadly? What is it?
Yeah, where's Ozempic when you need it? I think that what we're seeing here is this dynamic that we are still very much in a late cycle economy, that there are winners and there are losers. There are those with pricing power and those without pricing power. You see it this morning, Netflix pricing power, Tesla no pricing power. That has something to do with small ticket item versus large ticket item, but it also has to do with interest rates. And the cost of capital makes the operating environment more difficult. So in late cycle, you have to be hyper selective when you're picking your equities because there will be those that stumble.
I love your note. You go right to the top line. You look at the nominal GDP inflation overlay. You've got the Magnificent Seven sales growth up something like 35% year over year. Nobody's talking about the top line.
Yeah, it's extraordinary, and part of that top line is because they have that great pricing power. Some of that is skewed by NVIDIA. It's pretty wild. NVIDIA is going to grow earnings by 1,000% this quarter. 1,000%. But even if you remove NVIDIA, the Magnificent Seven will still be growing earnings by 60%. So if you take out the Magnificent Seven from this quarter's earnings would be down 4% versus the down 1% to flat that's currently projected.
Is that priced in already?
I think it is. I think it is to an extent because you've seen so much multiple expansion. It doesn't mean that these still aren't great companies, but if you look at the direction of growth, it slows materially going into next year. What you see is NVIDIA, for example, 1,000% goes to 33%. You see similar decelerations for other Magnificent Seven names. The market cares about second derivatives, so I think it'll be a really interesting test for leadership next year as we see that deceleration.
John was asking about American Airlines and whether some of the disappointments that we've seen from American, from United, are specific to this sector, or whether there's a broader withdrawal from consumer spending that you're seeing on the ground. Is there a dissonance between some of the official data and the anecdotal data, like what we got in the Beige Book, that points to a much more substantial slowing down?
Yeah, there is dissidence there. There's also dissidence within the credit card data. That was the big head scratcher. All the credit card data seemed to point to a slowing in consumer demand. We did not see that, of course, in retail sales. The best explanation I've heard of that is because the measurement period was after the credit card data was starting to roll over. So I think what we're starting to see is at the margin, consumer spending is starting to soften, but it's not broad enough yet that it's falling off a cliff. And part of that is just because the labor market still remains so tight and wage growth still remains rather robust.
So what's your prescription, except for load the boat on Apple? Julian Emanuel writes a piercing note today with Ed Hyman at Evercore ISI. They still are on recession 2024, but he says a defensive tilt is essential. Do you agree, or can you be more optimistic and buy shares today?
I think the defensives are certainly washed out. Right now, you look at big, huge put option buying within the staples, for example, utilities are very washed out, but they're still very much in downtrends. Our preferred way is to say we're willing to own cyclical names as long as they're high quality, meaning companies that have good balance sheets, have strong free cash flow, but the overlay on that has to be valuation discipline, because the higher you go in valuation, the more you have room to fall as valuations come in, as growth expectations come in.
Let's finish where you started, Ozempic. You've seen the performance of some of these packaged food stocks.
Yeah, they've just tanked.
Absolutely brutal. Yeah. It's brutal. Mondelez, Tom, down something like 20% since the peak earlier this year. How much is that stock, that company, going to change this market?
Look, I think that as long as what you're seeing is this shoot first, ask questions later, meaning that you're pricing in an impact of something that probably is going to take very many years to play out. And the fact that Walmart was already calling it out as far as weaker sales, that seems to be a really convenient excuse as to what they're seeing. So I wouldn't want to price all of that in. I think that's one of the reasons why staples likely are oversold at this point. It doesn't necessarily mean that they're going to lead the market in an uptrend, but there's some of that kind of inverse of what you're seeing in the optimism around the medical stocks.
So excuse, not a reason.
Yeah.
Okay, excuse, Bramo, not a reason.
I buy that completely for
Okay.
like the Walmarts and the snack companies. There is another story when it comes to healthcare companies that deal with some of the medical issues tied to morbid obesity. Because if you can treat that, and not just that, but Ozempic also is geared toward treating some other potential maladies, then that could be real because it's specific and targeted to individuals in certain places. That to me is more interesting.
What doesn't Ozempic do, based on what I've seen in the last few weeks?
It cooks your dinner, it tells
Right.
your kids to do their homework, it's fantastic.
I saw something about the kidneys.
Yeah, the kidneys, it's like a whole host of other issues that it can deal
Amazing.
with.
Cameron, thank you.
Thank you.
Cameron Dawson of New Edge Wealth. Wondering where we were taking the end of that conversation. It's going to stop there. If you're just joining us, welcome to the program. On the S&P 500, we're totally unchanged. We're negative by 0.01%. Yields are a little bit higher by 5 basis points. That's what we're focused on this morning. On a 10-year, 4.9641, getting closer and closer to 5%. Bank rate, mortgage in America. We'll discuss this a whole lot more later in the hour. But Lisa, 8%. 8%.
And basically what you're seeing is complete stasis in sales, dropping off a cliff, mortgage applications falling to the lowest in 28 years. We were talking about, well, things aren't really breaking, and Drew Mattis wrote in saying housing is broken. And a lot of people would say the housing market has broken because who is going to buy a home and take out a mortgage for 8%? It just increases the cost that much more dramatically at a time where prices are not coming down.
It's certainly frozen, that's for sure. TK, that housing market is totally frozen.
It's a separate thing. That's what Powell's going to say as part of the mix when he talks to David Weston today. But you know, to me, John and Cameron, I thought was brilliant on this. I'm sorry, there's a real yield. And this is something a huge body of the public has never really confronted. 2.53% moments ago out to a new high real yield. And I don't know, John, 2.6, I don't know where the world falls apart. But every textbook tells me that's what to follow.
You know this is going to be a big deal in the election, what's going on in the housing market, access to the American dream at the moment. What's happened with the Federal Reserve, and we're still trying to realize the consequences of this, to have both record low interest rates and interest rates at multi-decade highs, both in the space of a couple of years, is absolutely amazing. And Tom, the fallout from that, the ripples that you see from it.
Yeah.
We've got a poll that we're going to talk about in just a moment. A Bloomberg News and Morning Consult poll. The President of the United States lagging behind the former President Donald Trump in some key states. Arizona, Georgia, Michigan, Nevada, North Carolina, Pennsylvania, Wisconsin. That conversation with Bloomberg's Anne-Marie up next.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Today, the Economic Club of New York hosts a conversation between Fed Chair Jay Powell and Bloomberg Wall Street Week's David Weston. Recession risk, inflation outlook, real estate amid high rates, and more. The live interview happens today at 12 p.m. Eastern on Bloomberg. Context changes everything.
If Hamas confiscates it or doesn't let it get through, or just confiscates it, then it's going to end, because we're not going to be sending any humanitarian aid to Hamas if they're going to come be confiscated. That's the commitment that I've made.
The President of the United States speaking earlier today on Air Force One. Biden will address the nation tonight at 8 p.m. Eastern Time from the Oval Office. If you're just joining us, welcome to the program. Here's the price action on the S&P 500. Busy morning already on the S&P. Equity futures look like this. We're negative 0.05% in the bond market. It's kind of a wow 24 hours all over again. 5 basis points on a 10-year, Tom. 496.63.
Here's the move. That's a benchmark to look at. We made a lot of the 30-year rather yesterday, going through 5%, 5.06%. But I would look at it, John, holistically and globally as well. Yeah, we focus on the 10-year. There's a lot more going on than that.
Let's finish on crude in the commodity market. You will notice Brent a little bit earlier today broke below 90. Conversation of the past day or so, easing sanctions on Venezuela. And as Lisa mentioned, potentially kicking output higher there by roughly 25%. A production boost there, Tom, potentially in Venezuela, connected to arguably what's developing in the Middle East.
I saw one report of migration and sending people back to Venezuela. To me, it's just a domestic stew of the Caribbean and Venezuela going over, decades and decades?
You don't think the timing is relevant here?
I think the timing here has a little bit to do with it,
87.33 on WTI, Brent crude $90 and about 30 cents, Tom.
There it is. Right now, it is important that we get an update on Israel after all that we observed yesterday. We're advantaged by Anne-Marie Horton in Washington and Oliver Crook in Tel Aviv this morning. Anne-Marie, let me go to you first. The president looks exhausted. It has been an emotional 36 hours. What will President Biden do today?
Well, he's going to be making his only second Oval address. This is a direct appeal to the nation this evening at 8 p.m. And what the president is going to say is really try to make sure that he is explaining his foreign policy goals and explaining the need to continue to support the national security concerns of U.S. partners directly to the American people. So this is a direct appeal to the American people this evening, and it comes as we are expecting the White House to request more funding for Israel, more funding for Ukraine, as well as partners in the Indo-Pacific like Taiwan and border security from Congress. And we're reporting that funding request could be up to $100 billion. So this is the president taking that appeal after, on the heels of this trip to Israel, where he was able to sit down with Benjamin Netanyahu to really understand what is going on in the region. This is going to be his direct appeal to voters this evening.
Oliver Crook, what will the Prime Minister do today, and particularly what will the Prime Minister do in briefing and addressing his military?
So we heard from the Prime Minister of, well, it depends which Prime Minister you speak of, because we have the Israeli Prime Minister, who obviously is at the center of this. We have the UK Prime Minister, who is here now and has just spoken alongside Benjamin Netanyahu, giving some of the very same remarks that we heard from Biden yesterday. My read on it is a little bit more couched than the full-throated support, but basically the same message. In terms of Benjamin Netanyahu and the orders that he might give, again, we've been left guessing in terms of the when and what the ground incursion looks like. But as we've been talking about, Tom, the question is, what does this incursion look like? And is it going to be the full force rolling in occupation? I think that the Israelis have been sort of steering us away from that, thinking of more tactical, more discrete operations that may last a much longer time than that.
We've been talking, Oliver, and I do want to get Anne-Marie's take on some of the dissent in the United States. In Israel, how united are people around Netanyahu, a highly polarizing figure who has sort of been leading by proxy with a whole host of others with the war cabinet?
It's a very interesting question, Lisa, because, when I was here 7 months ago, the thing that defined Israeli politics was total dysfunction and a completely separated society. On the one side, where you had literally hundreds of thousands of people on the streets, it was a sight to behold every single Saturday, protesting the government and the judicial reforms that they were trying to push through. That, of course, has all gone silent in the last week and a half. But at some point, and you hear it a little bit under the surface, Netanyahu, in a lot of people's mind, is the person to blame for what has occurred here, particularly a prime minister who is has run with such a reputation on security. I think that a lot of people are waiting to have that conversation a little bit later, once they're past the sort of initial wartime. But that is certainly under the surface here, Lisa.
Anne-Marie, this president, the president of the United States, is facing some real difficulties abroad. Ukraine, Israel, facing some at home as well going into an election year. Anne-Marie, as you know, together with Morning Consult, the team here at Bloomberg News has put together a poll, and it does not make for good reading for this president.
No, absolutely not. This poll shows that President Biden is losing in some key districts, some key swing states. And what's so notable about it is that a number of these swing states he actually won in 2020. So the 5 of the 7 swing states that Trump is beating Biden is Arizona, Georgia, North Carolina, Pennsylvania, and Wisconsin. They're all states, Jonathan, he won in 2020, except for North Carolina. And the underlining issue that this poll shows is that it's the economy that really has voters on edge, and the inflation that is their concern. And they think that Trump potentially can do a better job. Also, we're talking about what's going on in Israel. We're talking about the aid that Biden wants to request as well for Ukraine. When it comes to foreign policy, even though President Biden loves to tout that he was the chair of the Senate Foreign Relations, that he was a vice president, he is now commander-in-chief. This poll, Trump is leading 11 points when it comes to China and about 7 points when it comes to issues regarding Ukraine. Voters in these swing states think Trump is stronger on foreign policy than the current president.
Let's talk about energy then. All roads seem to lead to that right now, Anne-Marie. What can the president do? We talked about maybe moving some levers like easing sanctions on Venezuela. What can he do going into next year?
Well, I think there's one thing that we need to understand and know, and is that the U.S. right now is at record when it comes to energy production. This is something that I think gets lost in the headlines when you look at higher gasoline prices or a higher oil market. There is concern in the energy market, especially in the short term, what could happen given the fact that we do have a conflict now in the Middle East. And if Iran was to become part of this conflict, that would mean a massive spike to oil and energy prices. What we've seen from this administration is they are going to allow Venezuelan crude to start moving again. But this comes with the fact that Maduro has to have free elections, and the United States can slap those sanctions back on if they do not think that he is operating in good faith.
13 months before the US elections. AMH, thank you. Ollie Crook, Ollie, stay safe, buddy. As always, Ollie, thank you. On the ground in Tel Aviv. This headline here, the front runner for the GOP nomination, the former President Donald Trump, leading Biden 47% to 43% among voters in Arizona, Tom, Georgia, Michigan, Nevada, North Carolina, Pennsylvania, and Wisconsin.
It's a good poll. The standard error of 1%. So the margin there, rather, is actually an adult margin and not a wish. What I find interesting is the lone state really glowing for President Biden is Nevada, which has, of course, Las Vegas and all of the labor towards the gambling industry.
Well, I wonder how much this kind of sentiment is going to really shape the speech that we hear tonight at 8 p.m. by President Biden to try to convince the American people to get on board with some of the initiatives that have gotten less popular as time has gone on. And I think this is sort of the dividing feature right now, is that both parties are looking for their North Star to sort of coalesce around. And they're both a little bit kind of moving away as the sort of further left and the further right are moving further from the center.
It's still early, but I do take the point that one of you mentioned, which is, you know what, it's always about the economy. We're all distracted by this horror in the Eastern Mediterranean, but the answer is it's about the economy. And, you know, to me, this yield move is the haves survive because of the haves, and the have-nots just get absolutely crushed, and that folds into the poll maybe more than anything.
I think the mystery remains the same for the Democrats, Tom. They're struggling with the following. They're going to cite the data. They're going to say things like, look at retail sales. Look at the trend for inflation. Look at the labor market. Jobless claims around 200K.
Look at the FICO score to Bank of America.
Look at all that stuff. And then someone turns back around to them and says, yeah, ask them how they feel about it.
Right, my
and then you
grocery
hear from
bill.
consumers. And I'm sorry, you can't sit here and tell people they're wrong about how they feel by shoving data down their throats. It's about how they feel.
And disinflation is a very complicated kind of concept to explain politically.
Precisely.
When your bill's going up, period, full stop.
Terry Wiseman and Macquarie on foreign exchange and this bond market coming up next from New York City. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Equities pulling back just a touch on the S&P 500. Down on the week, down on the session. On the S&P right now, we're negative by 0.1%. Positive on the NASDAQ, up by 0.1%. Netflix, looking good. Subscriber numbers, nice. They've got the pricing power, as Conrad Dawson at New Edge was talking about. They can put prices up. Suits? Is that where the pricing power comes
100%.
from? Okay. In the bond market, we look like this. 2-year, 10-year, 30-year, cycle highs in the last 24 hours. 524.20 on a 2-year. Unreal. Up a couple of basis points again this morning. Up 6 on a 10-year. 497.27. Lisa, we're up 5% on a 30-year. We're getting closer on 10s.
The problem is we don't understand why, and the whole curve is moving to 5% and beyond. And this raises this real question of, is this a sign that we have more inflationary pressure than we ever would have imagined, as data point after data point is surprised to the upside? If that is the case, how does that crimp the U.S.'s borrowing capacity in a more material way going forward?
It's getting expensive.
Exactly.
Let's put it that way. What's the ask? 100 billion for aid, Ukraine, Israel, for the border? Is the president going to address that later on today?
I'm guessing he's not going to come out and say, last time I was looking at Bloomberg, I saw the 10-year yield close to around 5%, which might crimp our ability to borrow.
Maybe they should be sitting there looking at it. I said a few weeks ago, how close are we to them waking up every morning in Washington and starting to follow this? Tick by tick, really closely. Congressman French Hill was already there, straight off the bat was citing where the 10-year was. I wonder how far that spreads, Tom.
Again, this is the economic thing that we're very comfortable with, over to a careful financial analysis, and I would suggest it started 2 days ago. And the shock here this morning, John, I can't round it up yet, 2.53%, up 6 ginormous basis points on the 10-year real yield.
497.27 on the nominal yield. I want to finish on crude just briefly. Had this discussion a little bit earlier if you missed it. Easing sanctions on Venezuela, potentially boosting production there. There's a lot of nuances, technical features of that conversation, but ultimately crude pulling back a touch. $90.33 on Brent, on WTI $87.35. Under surveillance this morning, President Biden delivering an address to the nation at 8 p.m. Eastern on the Israel-Hamas war, as well as Ukraine, following his brief trip to Tel Aviv. UK Prime Minister Rishi Sunak now visiting Israel in the latest effort to prevent the conflict from widening. Sunak is meeting with Israeli Prime Minister Benjamin Netanyahu today before heading to other regional capitals without specifying which countries exactly. That might be the best approach because based on the president's experience, those meetings, Bramo, can get cancelled at short notice.
And on the heels of something that still is highly contested, what I think is so interesting is that a lot of the leaders of the U.S. and the U.K. are trying to go direct to the client, to the constituent, because right now there is an information war that's been going on, and you can feel it in this material way. And everyone's trying to win, and there's disinformation, there's real information, who knows what it is, it's the fog of war. But right now, there is a real question of how do the leaders coalesce a majority to their side amid this dissonance?
I would suggest they're trying to harness the speed of technology and the speed of media here, and what there isn't enough talk about is what is the war development going to be. I thought
Lisa's onto something, Tom. The information war, and not just the broader
I like the phrase,
The President of the United States has come out and said that his Defense Department has told him that that blast at that hospital was the responsibility, his words, of the other side.
And I saw the first
within
map
his
of that.
own party, in his own country, he's got officials in the House going around and saying that Israel was responsible for it. That information war is not a foreign concept. Lisa, that's happening domestically.
And you could say what you will. There are a lot of independent examiners who are coming to the same conclusion. Ian Bremmer, I just want to say, of Eurasia Group, put this out on the platform formerly known as Twitter, saying the level of disinformation on the Israel-Hamas war being algorithmically promoted on Twitter is unlike anything I've ever been exposed to in my career as a political scientist. It's not just Twitter, it's across the board. This, to me, is one of the key questions as we head into the next phase. How do you get control of the message that's been disseminated in a very different way?
It's been pushed out by sitting members of the House of Representatives.
Correct.
Is that not a problem for this President of the United States?
It's his own party.
It is his fractious party.
In Congress?
Yes.
That's shocking, Tom. I'm surprised it's not headline news in this country.
I think it is.
And even after the Defense Department came out and put it, it was still just lingering there on Twitter.
It's headline news, including the protests that are going on in the rotunda of the Capitol yesterday and I believe today as well. So I do think it's news, but it's buried in the diplomacy, the visibility of it.
Well, the House is a mess, so let's go through it. The House of Representatives expecting to hold a third vote for Speaker later today.
Really?
Congressman Jim Jordan failing to get 22 votes from his own Republican Party yesterday after coming up short initially on Tuesday. He can lose no more than 4 votes as long as Democrats remain united. The post has been open for 2 weeks now. It's been 2 weeks. Feels longer, doesn't it, Lisa? But it's only been 2 weeks when Congressman Kevin McCarthy was pushed out.
Honestly, to me, I'm just looking at this. Why would he want to go up again for a third time? He's losing votes. He lost 2 Republican yes votes, and they changed it to no votes.
Getting worse.
It's getting worse. It's not getting better. So why go up again?
Yeah.
Why deal with this humiliation? I don't understand this.
To be accurate there, I believe it was 2 voting for him and 4 voting against him. So that was the negative 2.
It's dysfunctional. It's messy.
He has a jacket like you.
Does he?
Yeah, it's like the Pharaoh look.
What does that mean?
It's like a blue thing, and it's cut and chiseled because he's a wrestler.
That's the look.
You. Yeah, it's like you.
Cut and chiseled and it's blue.
Yeah,
okay.
It's a Pharaoh look.
Let's get to U.S. housing. Mortgage applications in the U.S. hitting a near 3-decade low. And this is part of the reason. The average national fixed 30-year mortgage has hit 8%, according to Bankrate.com. Tom, you've got to go all the way back to the early 2000s for anything that looked like this.
The way you do this at home is you figure out how much house can you buy, and here's the operative word: less.
Less. So true.
You know, that's all there's doing. The conversation right now is so important, including the conversation David Weston will have with the chairman here in the noonish hour, a fireside chat. We are so advantaged. His fancy title is Global FX and Interest Rate Strategist at Macquarie. But what's really important here is Terry Weissman's decades of work at considering the holistic view of interest rates moving. Dr. Weissman joins us this morning. I want to go, you go so narrow as to say Chinese renminbi has to react along with all of EM, and we are going to see a floating series of fixed currency solutions, which brings up the Great Triangle and is the only solution to all this angst we're talking about is an organized or disorganized currency devaluation.
For the emerging markets, I don't think so. We have seen quite a lot of devaluation in 2022 in a lot of the emerging market currencies. We've seen the Chinese renminbi devalue, depreciate this year. I don't think that this is restoring some sort of stability or growth to the market, to the economies globally. If you're asking me, is the increase in U.S. yields going to put more pressure on the emerging market currencies? I think it will. But the transmission mechanism there is actually quite simple. It's very difficult to want to hold any assets that are yieldy assets abroad when you can earn as much as you can in U.S. fixed income. And I think this is the underlying pressure that emerging market currencies are facing now, including, by the way, the Chinese renminbi.
There's a difficult sort of evil, vicious circle that people are getting concerned about, that as some of the developing market currencies depreciate, the governments liquidate more of their holdings, which are U.S. treasuries, to then go and support their currency. I'm thinking of China, I'm thinking of Japan, not necessarily a developing market, but still. There is a question about whether that just pushes yields that much higher in the U.S. How much is this becoming a sort of self-fulfilling cycle?
No, it certainly can. I think, though, that the countries that are going to be doing this the most are the ones that are concerned about inflation in their countries. But you have to keep in mind that China and Japan are not really inflationary economies at this point. So I think we're really limited to those countries that are inflationary, that want to stabilize their currencies in the face of what's happening with U.S. yields. I don't necessarily see China, for example, waking up one day and saying that the renminbi is too cheap at these levels. And we certainly haven't heard that from the Japanese either. So those are not really the countries we should be pointing to when we're looking at that situation.
From a broader perspective, you said that these higher yields are pressuring a lot of the developing world pretty substantially. And I'm just wondering at what point things start breaking, right? We've been asking that. At what point do things start getting a little unruly in the rest of the world?
I don't think we're close to that in the currency world, right? Look, for example, at South America that I'm very familiar with. You have seen the Mexican peso depreciate in the last few weeks, but remember, the Mexican peso had appreciated quite a lot in the past, in the 12 months previous to the depreciation we've seen. Same thing with the Brazilian real, same thing with the Colombian peso, same thing with a lot of the other emerging market currencies. So we're only at the point now where we're seeing the dollar against these emerging market currencies rise, but off of a very low base for the dollar in view of how much appreciation we had seen in some of these countries. Now, I'm not saying that appreciation came without any cost, right? The way that the emerging markets managed to get their currencies to appreciate last year, those that did, was with very high interest rates, very high real interest rates. Effectively, the situation is that is the problem, right? That is what is slowing those economies right now. Not the currency volatility so much as the fact that a lot of these countries still have very high real interest rates. They're still grappling with inflation issues.
I look at, I'm going to steal this from Game of Thrones, which is pointier in the math of it, the stochastic. If I look at even, say, Singapore dollar, you know what? This gets solved. They weaken and they get pointy, just like in Game of Thrones, and they come in. We get pointy and things get fixed. I'm going to assume they always get fixed by the United States. So when we get pointy in EM, in your world, if we get pointy, even in developing market like yen, I'm going to pontificate out to 153, 154. What does America do to bring in those excesses?
Well, first of all, if some of these emerging market currencies, including the renminbi, started to depreciate more, I think policymakers in the U.S. would not mind at all. Keep in mind, that would be disinflationary for the U.S. economy. It would provide or produce more flexibility on the part of the Fed to be able, if it wanted to move away from this tightening policy narrative that we've seen over the last few months. I think from the perspective of Americans who are concerned about inflation, and maybe this is the reason why consumer sentiment is so poor in this country, you actually want to see some currency depreciation in the valuation abroad.
Let's wrap it up. Chairman Powell, what do you want to see later?
Oh, I don't think that he's going to step out of line here. I think the narrative has been about high for long. I think you have seen some regional Fed presidents who happen to be on the other side of the spectrum increasingly vocal about the need to not raise rates anymore. But please do not read this as a signal that there should be more flexibility about the medium and long-term outlook, which is currently defined as high for long. That is going to stick. He'll probably repeat that. And even if they are on hold on November 1st at the meeting, high for long will still be an important part of the narrative. We are not anywhere close in terms of dynamic and the dynamism of the U.S. economy to make it a reasonable expectation for them to take that away anytime soon.
Is November a live meeting?
I think so.
Okay.
Yeah, no, I do. But I think that in view of how many of the regional presidents and those board governors that have been vocal about keeping things on hold, I think we're going to look at an on-hold situation in November 1st.
Terry Wiseman of Macquarie. Terry, good to see you.
Pleasure.
Thank you. Looking ahead to noon Eastern, Chairman Powell sitting down with Bloomberg's David Weston at the Economic Club in New York. Look out for that a little bit later live on Bloomberg TV and radio. If you are just joining the program, welcome. Your S&P 500 negative by 0.1%. Coming up a little bit later, Claudia Sahm of Sahm Consulting reacting to jobless claims data about 45 minutes away. The claims data, Tom, still in and around 200K.
It's been underspoken, and there it is. We're going to see that in less than 1 hour in the claims. And there's a whole bunch of theories. John Hatzius with a smart note with his team there about how claims are artificially suppressed right now. But Claudia Sahm heated on the nominal GDP and real GDP optimism that Justin Wolfers was talking about the other day on this boom economy. We had someone say 5% for Q3, which is shocking.
Did you see, though, yesterday's data that came out with how much the balance sheet of the American consumer increased over a 3-year period, a record amount in data going back to the 1980s? People have just been stockpiling so much more cash than anyone had imagined, and that seems to be fueling something. Everyone's been asking, when does it run out? It doesn't run out. out if jobless claims don't go up and if people are getting paid more. And that, I think, is the distinction that's causing a lot of people to change their view.
More than we realized.
Yes.
More than we realized.
To tie it into the Bloomberg poll, I'm sorry, it's two Americas, and there's this massive polarity here. And some of that polarity is engendered by a financial market on the move.
We need to talk about the airlines. American Airlines out a little bit earlier this morning, cutting the outlook. It's a tough time for the airlines. Jet fuel prices moving in the wrong direction for them through the summer. On top of that, maybe a softening of demand domestically, flagged by some of the domestic-focused carriers, Tom. I'm thinking JetBlue, Southwest over the past few months.
Totally agree, but every seat's taken. That's the difference this time. Every seat is full. Why
Which
are they
part of the
struggling?
plane were you sitting on? Did you turn around and look at
back? I look back. My people were back there, and
Were they? Oh, the entourage in the back.
Oh, dear Lord.
Okay, Brooke Sutherland, Bloomberg Opinion on the airlines, next.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Anytime you see rising economic and geopolitical uncertainty, which is what we're seeing now, that is bad for markets. It saps investor confidence, it saps company confidence, and we're just bad at pricing it. These high levels of uncertainty have unfortunately become a new normal.
Tell you what else is the new normal, and thank you, Ben Laidler over at eToro. These moves in this bond market is the new normal. Just big moves in either direction. We saw it again yesterday, see it again this morning. Let's check out the bond market now. 10-year yield, really close to 5%. Keep one eye on that all morning. 497.91.
Wow.
Up by 6 basis points. On a 30-year, up by 7. 5.06%. On a 2-year, up by 3. 5.25 on a front end of the curve. This bond market, Tom, it's been amazing to follow over the last few months.
With all the news flow, and particularly what Oliver Crook and Anne-Marie Horton are viewing in Israel, we forget that this is really a bond market on the move. And it's, John, across every single indicator, the disinversion, we were at what? A pre-Misra negative 100 basis points, and we've gone negative 100 to negative 27. Can I dare say begin to model where the 2-year and the 10-year are the same yield? Am I there yet? I don't.
Tom, I'm with you. I'm following the same thing. That curve steepening we've seen that's come from the long end, the jargon you hear from the bond investors, the bear steepener, the best argument I've heard for it, and this really is the best argument I've heard for it, comes from Steve Major and others as well. When you're in an expansion, not a downturn, and you are asking investors to go out along the curve and finance the government for less yield on a longer maturity in an expansion, you're going to get pushback. And arguably, Bremo, I know it's only one piece of the story because there are many in this puzzle, but that piece of the story is really, really important. How do you convince someone to go out on the curve, pick up a 10-year for less yield than a 2-year, when you're in an expansion, you see retail sales data like the data we saw this week, saw payrolls like we saw a few Fridays ago. So CPI and PPI still coming in a little bit hot. It's hard, which is why you're seeing this curve re-steepen.
Another way maybe of framing this is that the bond market is essentially saying what the polls are saying, which is recession is no longer the base case. And if that's the case, things get more expensive from here and inflation may not come down the way that people thought that it would. And people are losing the sense that the Fed has the conviction to do the heavy lifting necessary to inflict the pain required to get inflation under control.
Now, the question is, this is in an expansion. If things get bad, do people start to buy the bonds? That's the question. Typically, they do. And I will stress that's one piece of a much broader puzzle in this market right now. You can throw in China, you can throw in the deficit, you can throw in yield curve control and the BOJ backing away from that, QT, the ECB, all of the above. There's a lot going on in this bond market. I want to finish on American Airlines. Look at the stock right now. They've had to cut their outlook. The stock's still doing okay. The stock's been battered, though, over the last few months. Peaked back in the summer for many of these airline stocks back in July. New outlook, Tom. Adjusted EPS, $2.25 to $2.50. Previous outlook, $3 to $3.75. The estimate, $2.34. This is about higher fuel costs, Tom. It's about softer demand domestically as well.
The complexities here, we're going to get to it in a moment, but John, the way I look at this with all these airlines is I compare the price now to the COVID gloom. And American Airlines is just under $10 per share. So they're a little bit off the COVID gloom, I guess is how I would put it. This is a joy. Brooke Sutherland joins us now from Bloomberg Opinion, and far more importantly, a girl from Kansas, holding court at the Lawrence Journal World a few years ago, and everyone knows Kansas is glued to the heritage of American aviation. Brooke, Robert Crandall of American Airlines a few years ago changed our world. His arch theme was put fannies in the seats. We did. We went from capacity of 70 whatever percent up to, some would say, 102%. Why are the airlines struggling so bad if every seat's taken?
Well, I don't know that it is, and they're having to go to some great lengths to fill some of those seats, especially in the fall, particularly among the more domestic-focused carriers. JetBlue, Spirit, Frontier have all been running fare sales to try to stimulate demand to fill those seats. And part of the issue, to your point, is they have been aggressively adding capacity. We had that period post-pandemic where demand came roaring back and the airlines did not have the seats, did not have the infrastructure to meet all that demand. The natural response was to add more capacity. But now we're sort of on the other end of that revenge travel boom. It's not as strong as it was. We still haven't seen business travel come back, and the airlines have too much capacity domestically right now.
Okay, there they are. And I've seen the economy flights. The one I look at is New York to LAX, and maybe it's $700 in the boom down to $300. Do they have any ability to cut costs? I don't see it.
It's very difficult because their fuel costs have risen significantly. Their labor costs have jumped. Many of the airlines have recently signed new labor deals with a number of their unions. These are at very high price points. And there's always a natural lag in the airline's ability to pass those higher costs on to customers. But of course, that gets much more complicated if you are simultaneously running discounts to try to fill your seats. The ability to close that margin gap is a lot tougher.
How deep do the discounts go, Brooke? And I'm not asking as someone interested in travel. I'm asking for someone who is wondering how much of the price increases that have been dramatic over the past 3 years are going to stick longer term.
Sure. I mean, it is a bit difficult to get a good read on where airline pricing is. We have that CPI basket, but that does tend to be more heavily weighted to lower discount fares. That would seem to indicate that prices are actually down. Of course, that does not feel like they're down significantly if you are a person that is buying flights right now, but there is a moderation here. I mean, this is a consumer-facing product. I just don't think the pricing is ever going to be as sticky as what you might see certainly on the aircraft manufacturing side or any kind of air manufacturing business. Those tend to be a lot stickier. Those are a lot harder to trim down. There's a saying among a lot of industrial analysts that prices just don't come down on the manufacturing side, which of course creates another pressure point for some of these airlines who do need to buy aircraft in order to renew their fleet.
Which is the reason why there's been this focus on maybe reducing capacity by the big airlines and just charging more. So basically just catering to the people who have to fly and are going to have to pay the higher fees. How much does that become the model given how high the fixed costs, as you explained, have become across the board?
So we haven't seen a lot of big capacity cuts yet. No one has blinked yet. I wonder, at what point that might be coming. And I think, as fall goes on, if we don't see business travel materially come back, which personally I don't expect it to, I think, this is a very easy bucket of costs to cut. Pre-pandemic and especially post-pandemic, as we proved that we could do things virtually, it's a just much easier bucket to target when times get tough at companies. And so I think if you don't see that business travel market really bounce back, some of the airlines are going to have to take a hard look at their scheduling and think about if that really makes sense.
Brooke, in the Airbus-Boeing war, my amateur take is Airbus is winning. How bad is Boeing losing?
I think that is a very good take on what's happening in the market. That Airbus has, I believe, about a 60% share of that narrow body market, which is really the workhorse for a lot of these airlines. Look, I mean, Boeing has bounced back from the crisis. I don't think it's in anybody's interest to have a situation where we move from a duopoly in aircraft manufacturing to a monopoly where everybody just buys from Airbus. The waiting lists are very long for all of these planes. I think Boeing is holding its own. I think the question is, when you look out, in the out years, does Boeing need to invest in some sort of product that would target that sort of middle spot between the narrow body and the wide body? Airbus is developing its extra long range version of the A320. That's not a market that Boeing can fill at this time, and they need to figure out what they're going to do about that.
I don't think we want a monopoly in anything, but Brooke, just on the prospect for consolidation, can we go back to the airlines? What does that look like now?
Well, we're still waiting to see what exactly is going to happen with JetBlue's bid to acquire Spirit. The DOJ did sue to block that deal. That will be sorted out over the coming months. Personally, I think it's a little bit of a tough argument. If you remember in the railroads, that's also a very highly consolidated industry, and we just had a very significant deal there with Canadian Pacific acquiring Kansas City Southern. That shrunk the railroad market to the same degree that this deal would shrink the airline market. And I think it's a tricky argument to say that, allowing these two smaller carriers to combine won't create actually more competition. If you look at just how dominant Delta, United, American are, there is an argument to be made that allowing JetBlue to get stronger actually creates more options for customers. Now, the DOJ doesn't see it that way, but we'll see what happens as this gets sorted out.
Hey, Brooke, thank you. Brooke Sutherland there on the latest. My experience in America, talk a lot about competition. It depends where you want to go. Ultimately, if you want to go to one place, how much competition is there? What we've got is that basically Delta will own one part of the world, United owns the other part, America owns the other part.
JetBlue owns another part.
We're talking about competition. What competition is there?
I think that's a great point.
To me, it's a little bit better than it used to be, but you're absolutely dead on. I'm amazed how quickly the market's moving. LAX, I look at 2 flights, $700 down to 3-something, and I look at a Paris flight, business class, John, $16,000.
Of course, yeah.
And it's now $5,000. I mean, I did not realize, how, like Brooke said, how the prices have come down.
That's quite a headline, TK. It's quite a headline.
That is. Look at that. It's
Nothing
cheap.
personal about that, is there? Nothing at all. Coming up, Mark Esper, the former Defense Secretary.
We have been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
The Fed is going to try to be quite patient, especially with real yields where they are.
It's the speed of the move that matters, and we've had a pretty aggressive move in treasuries.
So far as central banks are concerned, the rise in bond yields that we've seen is doing some of their work for them.
Is the long end doing some of the Fed's work for them? Absolutely, but that's proving not to be enough.
We've entered a far more complicated phase of this cycle.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on television, on radio. It's the Fixed Income Report. We're doing that for Chairman Powell, 12 noon, David Weston. See that across all of Bloomberg. John Farrow, here's the numbers. This is like, it's like, bingo or whatever,
sure.
At 11
Go
p.m.
for it.
525, 498, and 506. Those are Powell's winning three numbers today.
Or losing, depending on how you're framing it. 2-year, 10-year, 30-year cycle highs in this bond market right now. Yields, let's frame it in simple terms. 3.30 in the spring of this year, 3.3% after the banking tension in this country, and seemingly cycle over. Here we are, almost 170 basis points later, higher, Tom, and still climbing this morning. The question for the chairman later on this afternoon, is that move a substitute for further action from this Federal Reserve if this economic data keeps surprising to the upside? And it has. CPI, PPI, retail sales coming in hotter than expected.
The bow tie word is unanchored. I don't know if they're unanchored, but I know in the last 48 hours, people are worried, to say the least, John. I mean, it's just, there's an angst here in the last 48 hours, yes, because of what we see in the Eastern Mediterranean, but separate from that, there's a new bond angst.
I don't hear that angst on the Federal Reserve yet. What I hear is that we can wait. Governor Waller used that phrase yesterday of the Federal Reserve, we can wait. And I think they want to wait for two things. They still don't really understand, from what I've heard, what's going on in the bond market. Right. Kashkari was perplexed. I still think they're surprised by the nature of the economic data coming in as hot as it has done as well. If you take Morgan Stanley's Ellen Zentner, she's looking for that slowdown in 4Q, acknowledging that the data's hot coming into the last quarter of the year, but still pushing the idea we get that slowdown in the economy. So if you're the Federal Reserve, do you want to pull the trigger in November? Or do you want to get another dose of data and wait until December? Which is why a lot of people have still got December highlighted and November just pulling back on the idea they do anything soon. And Tom, that can change with the chairman. It's up to him. He's going to get the last big word going into the quiet period. That can change with the chairman and David Weston later on this afternoon.
Maybe over lunch, it's first to do the harm. Bramah with the toughest job on the desk, trying to keep track of the Fed speakers along with the bond market. wisdom. It's just absurd. We have like 4, 5, 6 every day.
Well, today we've got 7, yes. Yeah. We've got, do you want me to do the whole thing?
Please.
Fed Vice Chair Philip Jefferson, Chicago Fed President Oscar Goolsbee, Fed Vice Chair for Supervision Michael Barr, Atlanta Fed President Raphael Bostic, Philly Fed President Patrick Harker, Dallas Fed President Lori Logan, and then, of course, Fed Chair Jay Powell.
From another era, though, before Arthur Burns, I'm going to go to the economist William Joel. That's how silly all this is. His great song, We Didn't Start the Fire, and it begins with the economists and speakers, including Truman and Jolton Joe DeMont, Doris Day, Walter Winchell. I mean, that's from another time and place. But to both of you, John, let me start with you. Is this too much communication?
Yeah.
Yeah.
Is the simple answer to that. But ultimately,
England does this better.
In what way? They speak less?
They speak less.
Well, there's fewer of them, so that helps. There's certainly fewer of them. We're talking about a 9-person MPC versus what on the Federal Reserve?
Right. We're going to do this.
Can I
Throw
just
in
say
the
one
rest
thing?
of them.
Please, please, please.
If they have something to say, great, speak. If you don't have something to say, does it muddy the waters at a time where it's very difficult to say something?
Yeah. Some of these are scheduled so far in advance.
Right.
So I have some sympathy for them. But ultimately, there are key figures you need to listen to more than others. Chairman Powell's going to set the tone today.
Yeah.
What he says goes going into the quiet period.
I want to sum up off something yesterday in John's observation on the United Kingdom and 6.7% inflation. And John, I said the duration of it is really something. It's a chart I've never seen. Ben Bernanke would call this a hockey stick. But the answer is, if you look at UK inflation on a steady trend, John, back 20 years and something changed 3 years ago, and it's the sum of that inflation move up 27%, and it rounds out perfectly to 10% per year in the United Kingdom over 3 years, over 3 years.
I saw you looking at RPI, which was kind of de-emphasized in the early 2000s, and CPI was sort of where the emphasis is now. Yeah, but same trend, same story, Tom. Inflation's a problem.
I just took it because it has TOTS tickets in it. But that's that's the emotion that we've got here. And look for Chairman Powell today with David Weston. Let's do the data here. And we already did it, but let's do it. I'm going to go to Brent crude 93, down under $91 a barrel, John.
Straight to the bond market, Tom, up 6 basis points, 497.27. The high of the session, just briefly a moment ago, 498.13. We are so close to 5% on a 10-year, Tom. This is not where people thought we'd be coming into the fourth quarter. They were looking for disappointing data. I heard calls like 350 on a 10-year, maybe even 3%. TK, look at where we are.
Yeah.
Up near 5% on a 10-year, through it on 30s, and at 526 on a 2-year. Remarkable stuff.
The bank rate, 30-year mortgage, 8% even. And now the most important conversation of the day for people south in bonds, worried in equities. Brent Schutte is Chief Investment Officer for Northwestern Mutual Wealth Management. He speaks to people who are scared. What is the emotion of the bond investors? Either they're in bonds, they're in 60-40. Brent, what's the emotion of the people with bond losses right now?
Well, I think people haven't seen these for quite some time now, and I think they're very worried and very nervous. To me, look, bonds now yield something. They offer real value. I don't know where the ultimate end to this is. I don't know that we don't go higher, but I think anyone buying treasuries today at 5% with a real yield of 2.5 plus is going to be happy in the next few years. And so to me, bonds for the first time in many years offer value, and investors should be buying them, not selling them today.
Brent, where on the curve?
Well, I think that ultimately I heard Tom's conversation about the Beloit, Wisconsin individual, and that happens to be in my backyard. I hope that no retiree is funding their near-term liabilities with longer-term assets. That, to me, is not just something that banks shouldn't do. It's also something individuals shouldn't do. And so I think it depends upon that. So what is your income stream that you need? But to me, I don't want investors to set in the front end of the curve, because who knows where interest rates will be in 2, 3, 5, and 10 years. Think about your comments opening up about 3.3% and people expecting it to go lower. Look, I think people who invest only in the front of the curve forget about reinvestment risk. And to me right now at 5% of the 10-year, I think that's an attractive area for people to begin thinking about.
Brent, typically when a client would come to you and you talk about balance and diversification and that old 60-40, has that balance and diversification idea shifted given what's on offer now in the bond market?
I think it has. I mean, if you think about the last 10 years, equities have done the heavy lifting. Bonds basically weren't much of a help to the overall return. It didn't mean that you shouldn't have them. It just meant that they didn't offer much in the way of returns. They certainly funded some near-term liabilities. But to me now, bonds at 5% yields, I mean, the Bloomberg aggregate, your own index, yields 5.7%. Typically what you buy a bond at especially if it's higher quality, is what you get. And so to me, over the next 5-10 years, a 60-40 probably looks a little bit better, and the bond side is doing more of the carrying.
Brent, you talked about reinvestment risk, and people have been talking about this all year, even as the best returns in the fixed income space globally have come from cash. At what point is cash better than people want it to be? Because ultimately, if you take the Fed at their word that they're going to keep rates higher for longer, this is going to be the most secure investment that potentially you could make.
Look, I think the Fed keeps rate higher for longer until they get a recession. And I'm not for sure how far we are off from that. To me, the Fed has the resolve. They do not want to repeat 66 to 82, which is what Powell mentioned in his last press conference, where he talked about letting inflation kind of keep going, which was wage inflation, which caused the Fed to have to keep coming back in and over and created a miserable period. They don't want that to happen. To me, wage growth is still too high, the labor market's too tight, and the Fed isn't going to stop until they get wage growth lower, which to me means a recession. And so I think that's on the horizon. And when that's on the horizon, I think you want to own securities that are just a bit longer than cash, because there certainly will be some, pullback in the shorter term yields.
At this point, though, that's actually counter consensus. That's actually pushing against the grain, where people are really writing a recession off the table in the next couple of years. How much confidence do you have in this? How aggressively are you legging into the long end of the curve? Are you buying 10-year treasuries?
I'm happy to be against the contrarian person again. I mean, I was the person last year who liked equities when everybody else thought the recession was coming, and I thought inflation would come down because it was tied to COVID. And if you look now, all-in CPI and core CPI less shelter is at 2%. Look, I feel very comfortable that we are near the end of an economic cycle. I don't know, nor does anyone, when exactly the recession will occur. But at the end of an economic cycle, you want to behave just a bit better. And that's where I think buying longer-term or intermediate-term bonds offers some protection against downside again in equity markets.
Brent, on a Sharpe ratio, do you have any idea where the risk-free rate is? We didn't know where it was for, 10 years, 12 years, 14 years, and OMG, we can actually measure the puppy. No, we can't. Do you have a clue where the risk-free rate is?
I think it's probably higher than what it was. I don't think 2014 to 2020 was anything normal. I don't think it was the new normal. I think you're actually back to something more normal historically, which is a real rate that's higher than what it was, because you now have consumers who have rebuilt their cash coffers. You now have companies who have done the same. I mean, the world's awash still in liquidity, which is retracting. I think rates are likely to be higher. And I'll add one more point. I mean, real buyers demand real yield. For years, central banks were the buyers, and they didn't care about real yield. And so you're kind of seeing the hands change in the bond market, which I think all this is perfectly rational. So I guess in a long-winded way, I think the real yield is higher. I think that 2.5% real neutral rate the Fed keeps penciling in has to go up. And so I think it's probably higher, but it's certainly not where we're at today.
Lisa mentioned the work of Dilip Singh over at PGIM regarding that, Brent. Just lost that price-insensitive buyer. Lost that predictable source of demand with the Fed and other central banks backing away. Brent, I want to finish on this, and it warrants a much longer conversation, and we can do it again in the future as well. The events of the last few years and the policy response to them have arguably screwed up this mortgage market, this housing market, potentially for a generation. And Brent, as you know, for a lot of people, the biggest asset they have is their house. Now a whole generation faces the prospect of not having that. Brent, what does that mean for how investment is going to change for them in the years to come if that frozen housing market doesn't unfreeze, doesn't melt?
Yeah, I mean, this is where you keep mentioning the 8% mortgage yield, and that's something that is in today. To contemplate that the effective mortgage rate in the U.S. economy is 3.6%. That's why the housing market is frozen. I think it only unfreezes when one of two things happens, or probably all of them. Prices come down a bit more, or rates come down, which I think will eventually occur as you get that recession. I think you'll see a pullback in mortgage rates, which will hopefully unfreeze the existing homes market. Certainly the new home market has been a place that you can actually see some unfreezing, but it's probably, the housing market is probably not going to continue its ascent that it's had over the past few years and decades.
Hey, Brent, thank you, sir. Brent Schutte there on the latest in this market and the housing market as well, just messy. If you're just joining us, welcome to the program. On the S&P 500, we are negative here by 0.1%. Yields are higher by 6 basis points on a 10-year, 4.9727. You can track the effective mortgage rate on the Bloomberg terminal if you would like to do that. USMIRATE, the current effective rate on the outstanding pool of mortgage debt is 3.6%. Do you know what the low was? Spring 22, 3.3%. Amazing, Tom, how low that was. Climbing, and it's going to take a long time to climb as well, because a lot of this is 30-year stuff. 30-year stuff, Tom.
You know, particularly like Bramah, where you're putting 2% down. I mean, you know, you get a pop off that mortgage.
Bramah likes to brag in the commercial breaks about the two-handle on. I know.
Not the two-handle on my down payment, the two-handle on the mortgage.
Bramah, don't worry, no one's confused.
But he was
Everyone's
saying,
got faith in your ability to invest, don't worry.
I'm one of the high FICO score people.
It's Lisa Abramowitz. Let's get this mortgage done.
Bragging rights in 2023 is not a Lamborghini, TK.
No.
It's a 2 or 3 handle on your mortgage.
100%.
We get notes in here like crazy. And thank you, Stuart Kaiser, for an options note from Citigroup. John, a week from now, the tech frenzy starts, maybe with Netflix, but, you know, Microsoft, the 24th, Apple. And Citigroup's modeling out, hey, stupid, buy call options. I want to make clear, this is a speculation. This is not investment. But Stuart Kaiser, constructive on the market, has a note, a tech call option speculation.
That's to capture the upside in tech. Apple, Tom, November 2nd, day after the Federal Reserve decision. So just around the corner. My favorite part of earnings season, 2 reasons. Prefer to hear from the tech names, 1. 2, they deliver them after the bounce. You get to sit there.
It's great.
Watch our colleagues just take it in and,
choice,
you know, read the documents. That's always good. From New York, this is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Today, the Economic Club of New York hosts a conversation between Fed Chair Jay Powell and Bloomberg Wall Street Week's David Weston. Recession risk, inflation outlook, real estate amid high rates, and more. The live interview happens today at 12 p.m. Eastern on Bloomberg. Context changes everything.
The president and a number of his advisors firmly believe that the post-9/11 years drew the United States into a dark place. I think part of the president's trip to Israel and his work tonight during the speech will be to shape the U.S. domestic audience, where we've seen a number of protests, to include anti-Israeli protests in the U.S. Capitol yesterday.
That was the brilliant Norman Rule there, the former senior U.S. intelligence official on the latest on the ground in Israel and across Gaza. From New York City this morning, good morning and welcome to the program. Just to touch base on what's happening in the price action right now on the S&P. S&P 500 futures slightly negative, down 0.1% on the S&P. Yields a little bit higher by 5 basis points on a 10-year, Tom, 496.84 earlier on, very close to 5% at 498.13.
We're watching the bond market very closely here, and of course we'll go off the economic data here in about 12 minutes. We've underplayed it today, but nevertheless, claims is important. Oliver Crook is in Tel Aviv, and he is reporting there on military efforts to come. We made a decision at Surveillance that we would really focus on people with tangible active skills. We had Elliot Ackerman on the other day, former Marine, I believe, 1st Battalion of years ago with any number of tours of duty. Admiral Stavridis joined us the other day, and now Mark Esper joins us. He's got a big fancy title, forget about it. He's a Screaming Eagle of the 101st Airborne with on-the-ground experience. He's the former U.S. Secretary of Defense. John?
Mark Esper, I'm pleased to say, joins us around now. Secretary Esper, fantastic to catch up with you, sir, as always. I wanted to lean on your experience in the administration. We've seen some landmark accords come out of the Trump administration, the Abraham Accords, just establishing diplomatic relations between Israel and places we never thought we would. We were hopeful that was going to take place with Saudi Arabia and Israel. It hasn't. Mark, are we learning that there are some forces in the Middle East that just don't want peace?
Yes, of course we do, and that is Iran, principally, and then there the proxy groups around the region that they support, Hamas, Hezbollah, the Houthis, the Shia militia groups in Iraq. Look, I think a big part of what motivated Hamas to attack at this time and the way they did was the fact that the normalization accord between the Saudis and Israelis was moving forward, albeit slowly, but moving forward. And of course, if it was concluded on the terms that we knew that were leaking out, that would have meant a tremendous shift of power back to the Palestinian Authority, which, of course, we know that Hamas is opposed to, right? There's friction between Fatah and Hamas. And of course, Hamas's benefactors, Iran, would also be hurt by normalization because you'd finally see an alignment or an emerging alignment between the Arab states and Israel against Persia, against Iran. So I think those are principal reasons why this attack happened at this time.
The political battle will be engaged, the look back, the 2020 hindsight, Secretary. What I'm fascinated by is how we prosecute a military affair with Israeli forces, okay, fine, against terrorist groups. We've never really done this, have we?
Well, I mean, you could argue that our response after 9/11, when we went into Afghanistan first to displace the Taliban, and then, of course, the pursuit of Al-Qaeda and eventually ISIS, et cetera, was part of that. We, of course, yes, we went after ISIS in Syria as well. So, but I get your point. Look, it's very tough. You have an army built for big, heavy conventional fights, an extraordinary soft capability, going into a heavily populated dense area, trying to root out militants among the public and having to fight in multiple dimensions, right? On the ground, above the ground, and below the ground. And it's going to be quite a bloody and messy affair.
What would the Screaming Eagles do? I mean, you know, you've got tangible experience here. Do they do a massive bombardment a la World War II, say, and then go in? Or do you expect them to prosecute something different?
Look, I think we've seen the bombardment so far. At some point, they're going to have to move in and go street by street, block by block. I think part of the reason why you see so many airstrikes is they're rubbling buildings. I will tell you, you know, you refer back to my time with the 101st Airborne. When we were in southern Iraq at the Gulf War, we wanted to avoid cities because city fighting is really tough. It consumes a lot of soldiers, not just those you lose, but you have to leave people behind. And again, when you're fighting in multiple dimensions, this is really tough. So I think they go block by block, being very careful to avoid civilian casualties. At some point, they occupy. But the really big question that we don't know yet is what's the end state? What happens when they're done? Because at some point, they're going to pull out. They want to pull out. And what vacuum do you create? Do you somehow politically get the Palestinian Authority to come in? Is there some type of inter-Arab peacekeeping group that comes in? Those are the big unanswered questions. What does the end state look like?
Secretary, you were Defense Secretary under the former President Trump. How would have his response been different to what we're seeing today?
I'm not sure that it would be different in this moment. I would argue that it would be different with regard to Ukraine and other countries. But with Israel, given the close connections between our countries, our peoples, so much that's shared between our two countries, I'm not sure it would be that much different. Although I would say that I think Trump would probably take a harder line and a more public line against Iran. I've argued for that in the past. I know Secretary of State Pompeo has, and I would like to see more from the Biden administration about connecting the dots back to Iran, because I think at the end of the day, while Israel can go in and decapitate Hamas and try and suppress them, unless you deal with the country, Iran again, who's funding and training and supporting them, then I think Hamas just crops back up over time.
How do you deal with Iran? I mean, this has been one of the big quagmires for a lot of nations, especially given that people want to avoid, World War III.
Yeah, look, I'm not arguing for strikes on Iran right now, but I do think we should see a consensus emerging first between the Western democracies, United States, Europe, and elsewhere, about really finally tightening down economic sanctions on Iran. You could go after their energy exports, and I know what that does to the energy markets. And then you could talk about further isolation of them. And I just don't think we've seen a concerted effort over the past, 5, 6, 7 years, and certainly over the past couple. In fact, some would argue that the administration has been so eager to find a nuclear deal with Iran that we've given them too much. And look, there's a good case to be made for that. But I think we need to recognize that Iran is at the root of all these problems.
Secretary Esper, if we can finish on drawing on your experience, what do you suppose is happening right now? What we're witnessing from the outside looking in is a period of intense diplomacy, a troop build-up, seemingly on the brink of a full ground invasion. What do you suppose is happening right now on the ground, and what do you think you're going to see in the coming weeks and months?
Look, I think from the Israeli side, they're gathering intelligence, they're prepping their forces, they're talking about their battle plans, doing some final training and making sure they know the game plan to go in and how they're going to deal with it. I think that's happening at that level. At the same time, they're reinforcing their northern front with regard to Hezbollah in southern Lebanon. And they also have to keep a presence in the West Bank in case that rises up. I think President Biden's made good moves, moving the carrier strike groups into the Eastern Med. The Marines will soon be following in there as well. But one thing that has been talked about is this. Look, if Hezbollah opens up a front in the north, we're going to get involved. We have to at this point, given what we've said about deterring Hezbollah, Iran, and others. And so if Hezbollah opens up a real front there, I'd see American involvement happening with Tomahawk strikes, maybe airstrikes. But we have to talk about that. And as you know, there's the grander chessboard out there with regard to diplomacy. I'm pleased to see Tony Blinken going around the region. I think it's important that we try and keep that Saudi-Israeli normalization deal on hold, make sure it's not dead. At some point, we're going to resurrect that because in my view, if Hamas and Iran hates that deal, those are two good reasons to pursue it. And I think it would really change the dynamics of the region.
You've got about a minute left, and we can explore the following. I think it would be beneficial. Is Turkey the missing link here? Where does Turkey stand in all of this?
Turkey stands in every place. I mean, they straddle multiple fences, right? They're criticizing Israel right now. They obviously have a large Muslim population, but they're also active in southern Turkey, northern Iraq, going after our friends and partners there. I mean, they play this game multiple angles. On one hand, they're with us in NATO, but he's supporting Putin in other areas. And of course, what we're not talking about is there's a conflict emerging between Armenia and Azerbaijan, not too far away. So you see the world fracturing here in these different spots at this time, and it all traces its roots back decades in many cases.
I'm with you. Some of these key issues just totally off the radar right now. Mark, appreciate it. Let's catch up again soon. Mark Esper there, the former U.S. Defense Secretary and author of A Sacred Oath. Thank you, sir. TK, the latest.
The 700 pages, A Sacred Oath, was really controversial. In his short term with President Trump itself was controversial. This guy hugely experienced.
Really, really complex stuff. We'll continue the conversation in the next hour on the market. Priya Misra, JP Morgan, John Bavad, BlackRock, Barry Bannister, Stifel, Pierre Ferragut of New Street Research on Tesla. All of that still to come from New York City. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it is then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Bloomberg Surveillance, Jonathan Farrow, Lisa Bramlett, and Tom Key. Mr. Farrow in deep preparation for the 9 o'clock hour as well. Lisa and I here with claims, and we're here with an historic bond market. We've got a really important 7 minutes for you. Claudia Sahm will be on, more than opinionated on what Chairman Powell needs to do, and also opinionated here with 2 seconds to go to the anticipated claims report. It's a terrible number. The job market is falling apart. Michael?
Maybe economists are falling apart, Tom, because the number of claims goes way down, 198,000. That's down from a prior release of 209,000. We'll get the revision for you in just a second. Continuing claims rise just a little bit, 1,734,000 from 1,705,000. So a few more people holding on to their claims, not getting jobs right away, but very few people losing jobs. 211,000 is the prior number. So we go from 211 to 198. Fairly hard to believe under the circumstances. Philadelphia Fed is out, and it is a -9. That's down from or up rather, in the way they look at this, from a -13.5. So a little bit better news there on the Philadelphia Fed. The employment index for the Philly Fed comes in at 4 from -5.7. So the employment outlook improves a little bit in that district. We'll see how that carries over as we get closer to the payrolls report for the month of October. But again, a big surprise today in jobless claims. We have been waiting and waiting and waiting for the auto workers' strike to show up, and it just doesn't.
You see that in the markets churning here. To be quick here with the importance of our guests, up 4 basis points in the 10-year, 4.95%, a little bit of green on the screen in the equity market. Michael McKee, what's your first question to Chairman Powell today?
Well, I think it's kind of a combination of questions. Either is it real rates or your rates that are going to matter going forward? In other words, if real rates keep going up, can you stop raising the Fed funds rate? And also, you want to know, if you're going to be higher for longer, how long is longer?
Mike, do you think that Fed Chair Jay Powell is comfortable with the moves that he's been seeing in the market? Do you think that he's going to push back against, in any way, what we're seeing?
I don't think so. I mean, markets go up and down, and they tend to overreact all the time. So, yes, maybe he might think we're a few basis points or so too high on some of these, but he knows that all it would take would be one bad economic headline and they'd go down again somewhat. I think they're comfortable with the overall level of restraint that market rates are putting on the economy.
To sort of put a bow on this, there's a question of whether the Fed is no longer the narrative, or whether they're not driving this ship. It really is the economic data that keeps surprising to the upside, with the latest being jobless claims coming in yet again much below the expectation. Why do people keep underestimating just how strong this economy is, Mike?
Well, that's a good question for any of the economics guests that you have, but I think it's because the models are broken and people really don't understand why the economy is behaving the way it is. But as to the Fed in the driver's seat, if they decide in the face of the high job gains that we have seen, the low jobless claims, the strong retail sales, strong industrial production, that they're not going to raise rates, then they're still in the driver's seat because the data would suggest Atlanta Fed says 5.4% growth in the third quarter. The data suggests you should be raising rates if you're afraid of inflation.
That's exactly where it was, Mike. I've got it up here on the Bloomberg screen, 5.411 on that Atlanta GDP now. Michael McKee, thank you so much. In Washington, they have to be kept in separate offices in Washington. Claudia Sahm joins us right now, former Federal Reserve economist, with a blistering note yesterday on America's economic growth. You were channeling Michigan's Justin Wolfers, Claudia, yesterday, and it goes off a 5 handle on GDP. Why is America so miserable if we're popping 4.5%, 5% real GDP, throw on the Claudia Sahm inflation? Why are we so miserable with 7% nominal GDP?
That's a tough one. Right. There can and there have been in the past disconnects between the kind of numbers that we see about the total economy and what families are telling us about how things are going and where they think things are going. Sometimes families are correct, right? We don't want to discount this. And yet at this point, we have gotten just all kinds of readings on what's going on right now. And they look really good. So it's been a real slog since the pandemic began. The inflation has been high, but things are good, especially the labor market.
Torsten Slack writes a brief note today at Apollo, and it sums up the consensus of the Fed. We're returning to 2%. Lagarde said that in Marrakesh. We have to get back to 2%, I believe, to paraphrase. And the Richmond Fed has a model which is a higher R starred. Is this a Fed that's going to have the facts change when they change, or they change when the facts change?
Yeah. What we've seen so far is inflation is coming down, right? If we had seen it still sticking or going up, then okay, fine, R-star's higher, they got to do more probably. That is not what we've seen. All of these models are based on past historical relationships, and we're writing the playbook here. And the Fed has shown themselves capable of rewriting the playbook. They did that after the Great Recession. So they're going to go where the data takes them. But it's really tough when the typical guideposts just aren't working the way they have.
Claudia, what do you make of the fact that the Beige Book and other anecdotal data really has pointed to a real softening, a slowdown, pain felt among the consumers, and the hard data keeps coming out surprisingly strong again and again and again?
Right. I don't look at the latest numbers that we've seen, particularly that 5% GDP growth that appears we're headed at, and say, oh, things are accelerating, we're going back up to where we are. I think this is a sign that we're bumping around a pretty good place in terms of a sustainable recovery. Obviously, that's not going to be felt by everyone. You can absolutely find people to give very heartbreaking stories about what has happened to them. And yet we do have to look at the totality of data, and it's across the board looking really good. We could keep up a sustainable pace that looks a lot like, if not a little better than where we were before the pandemic.
So do you think that this is becoming problematic for the inflation story, right? I mean, in other words, is this growth incompatible with inflation continuing to go down to 2%? Or are you basically arguing that it doesn't matter if we get back down to 2%, and that really needs to be what perhaps Fed Chair Jay Powell talks about today?
We're going back to 2%. The Fed is absolutely capable of getting us there. And they may get a little too antsy, and we get there with a lot of disruption and potentially a recession. I don't question that target. It's as made up as 3% would be. So, there's nothing magical here. We haven't seen signs of this being difficult. Inflation is still chipping away down. It's a different story if we start getting stuck, and then you've got to think harder about what's next.
Claudia Sahm with us, all her good analysis of recession, and Michael McKee with us in Washington as well. To the two of you, I've got one question. Mike, let me start with you. Our audience on radio and television is looking at a mortgage rate of 8%. It's either outright shock or how do we adjust to that as citizens? How do we adjust to that within our daily life? From where you sit, Mike, is the Fed aware that a 30-year mortgage is 8%?
Oh, of course they are. And I've talked to many of them about that, and they do recognize it is a bit of a problem and conundrum because they've raised rates and sort of killed the housing market because they're in a different situation than we have been since I can remember, where their rate increases are so much higher than what people were able to take out mortgages at that nobody wants to sell their houses. The thought seems to be that if they start coming back down, they will get to a level maybe in the threes where mortgage rates will come down to 4 or 5%, and people might start buying again because that won't seem too bad. But it's going to take a while, obviously.
Oh, Claudia, bring this over to academics as well. You're writing the next paper at Jackson Hole here on the American housing market. Are we at a point, Lisa and I have talked about this, are we at a point where for elites like you, the housing market doesn't matter?
Not just for me, right? There were a lot of people that refinanced or purchased housing when we had a very low interest rate. I mean, the housing market has been very disrupted, both in a really good place and now in a really bad place. Like, this has been a tough cycle, and those who timed it properly, and there were millions of Americans who refinanced their homes, they're in a good place right now. And like you said, it does make it tricky. They don't want to sell. They don't want to let go of that.
Lisa, we're completely colored by this in New York City, which is a completely wacko, original housing market. To me, this is the arch. We have to live in our houses. I believe that, like every month it's a mortgage payment or a rent payment. And these numbers, to me, have a greater effect than anything else we talk about. 8% mortgage filters into everybody's pocketbook.
It affects their mobility and their willingness to move, especially given the fact that it's going to be unaffordable for the vast majority of people to do so. Claudia, I just want to bring that together full circle with this idea of the conundrum that a lot of investors have right now. Are we seeing a world that can manage with 5% rates and keep the growth profile that you're talking about and that we're just seeing today, with claims coming in the lowest since January? Is that what we are witnessing?
It's too soon to tell, but we are absolutely setting up what could be, the really important piece of this would be productivity picks up, right? That we're talking about growth that's not just quarter to quarter, but we can really sustain it at a higher rate.
Right.
Then we can deal with the higher interest rates. There are some glimmers of hope. I mean, that's all productivity looks like right now in the data, but that's the path. And then we'd need Chair Powell to have a Greenspan moment and be like, growth has picked up. But we're not there yet. He shouldn't do that today when he does the Q&A.
When we're there, this is great. Claudia Sam, thank you so much. Michael McKee, thank you so much. And that encapsulates it perfectly, Lisa. We're in shock of a bond market. We have an 8% mortgage rate. I think we're benumbed by what's going on in the Eastern Mediterranean. And the answer is Claudia nails it in that we need to have a Greenspan moment from Chairman Powell and David Weston today.
The problem is, I'm not sure how much control Fed Chair Powell has over the narrative. I'm not sure how much control he wants to have over the narrative. They don't know what's happening exactly in the underlying economy, as none of us do. And the bottom line is that the bond market right now is responding more to the economic data, to potential deficits, to potential structural changes than they are to Fed speakers who really haven't made a major impact on yields with what their comments have been.
And what's important here is, as we talked earlier, the linkage here of our economic discussion with our financial discussion, which frankly affects Americans a lot more. And just in the last 48 hours, finance reigns supreme here. Do we really care what jobless claims are, or do we care about what the 10-year yield does to our auto loan?
They're connected, right? If jobless claims are going down, not going up, if you're seeing a really robust labor market, people can afford to pay for a car, even with higher financing rates.
We're going to dive into this. A data check here. We got green on the screen. Bramo driving the markets higher. Futures up 4. Dow up 4. How odd is that? The VIX under 20. That is critical right now, 19.30. Brent subsides 93 down to $91 a barrel. The 10-year yield is unspeakable, 4.94%. And the litmus paper for so many pros, Lisa, is where you are excellent, which is the credit market. Did those spreads widen out in the last 48 hours?
A little bit, as you see right now, if you are just joining the program, S&P futures just up by 0.1%. Tom, to answer your question, there is this question about why we're not seeing more stress. And the irony between all of this is that we have a bond market that is the full faith and credit selling off, but companies are doing much better. and that is the consistency. Here's the issue, and I said something, and I want to take it back or modify it a little bit. I said, even if rates are going up, people can pay for it if you have such low jobless claims and if you have such a strong market. Not everybody. And you've been pointing to this, Tom, and I think it's a very important point. There is an entire swath of people who are getting cut out of both financing, of the economy, and of, frankly, being able to have the basic necessities at the same level that they used to.
I'm looking at 2,500 square feet, Lisa. This says Bramwell on it. It's clocking in at $10 million on Amsterdam Avenue. I mean, that was something you could have slid into at 3%. What are you going to do at 8% on a $10 million unit?
Well, we heard from Brent Schutte, one of two things need to happen or both need to happen. Prices need to come down, and you need to see rates come
Good
down.
luck with that.
And the two things go in tandem. You get recession, you can see prices come off, you can see yields go down. But until we get that, how do we get there?
Thanks to Michael McKee and Claudia Sahm on your 8% mortgage, your American housing market. Coming up, we look again at the markets here, trying to get to the open. Joanne Feeney joins us, Advisors Capital. Stay with us, Bloomberg Surveillance.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
We are not detecting any clear signs of financial stress. These numbers are certainly, concerning. We actually think that the system can withstand rates getting to 5.5%. The most important point, of course, is how quickly they're going to get there.
That was Seema Shah, Chief Global Strategist at Principal Asset Management, earlier this morning. Right now, we are seeing a bit of stasis in equities, even as we see anything but in the bond world. And I can just say, to me, Tom, that is one of the big takeaways. The S&P futures, yes, we saw risk off, but to me, have been relatively immune to what we're seeing with 10-year yields nearing the highest levels going back to 2007.
Jeffrey, you talking about the non-correlations out there, and they are there in spades in the equity market. I mean, is Netflix a Dow component? I can't remember. But the answer is, there's some green on the screen after some red 2 hours ago. Critically to me, I'm watching the VIX, which I know is amateur hour, but that's what I do. And the answer is a number of research notes saying 20 is a key level. We're at 19.25. And that signals, like with the bond market, OMG, we ought to be at a 23 or 25 VIX, and we're not.
Well, and this is because it's the bond market and the questions around why. The strength has been in the equity markets, and the consistency of that we're seeing in some of the earnings. I want to go through a number of names because it is earnings season. American Airlines came out cutting their full year forecast. Normally you'd think, oh my goodness, the sky is falling. They're not able to make up for higher costs with higher fees that they're charging their customers. No, and that's because they downgraded their expectations so much heading into this that their shares are popping more than 3% on the heels of a sort of weaker than expected forecast forecast. It gives you a sense of kind of where we've come from.
I look at American Airlines 40 to 11. It was 40, all the pandemic help, and it's just, with all the airlines, it's not just American, it is challenging.
Netflix, I think, is interesting because they're able to increase prices and crack down on password sharing and still see their revenues grow 15% pop. Some of the high flyers seeing pretty big upside if they outperform. I think that's interesting. Las Vegas Sands, people still going on vacation. It sort of goes to this question of when do people run out of discretionary income? Well, not soon enough to stop going to some of the casinos, at more than 5%. Tesla, I want to sit on this for a minute. Tesla came out and they really disappointed. What I find most interesting, Tesla has always been a margin story. They have been a story of bigger margins than for a lot of the other auto manufacturers. And those margins are compressing as they cut prices repeatedly to compete with China. To me, I think that is the story to watch as those shares go down more than 6%.
Are they a tech company or are they an auto company? And the report to me was very auto-ish. That's my new word for the day.
All of a sudden, production hell. He started talking about the actual nuts and bolts manufacturing of this.
Manufacturing a car. In my study of big three autos over a Mario Gabelli lifetime, is it's a single-digit business. Is Elon Musk ready to do a single-digit business? No.
Maybe he can go to Detroit and get some advice over there, where I hear that they're still, full of time and no problems whatsoever. Joining us now to talk, particularly with a focus on earnings that we have perhaps neglected more than we should have, given all of what's been transpiring in the Middle East, is Joanne Feeney, portfolio manager and partner at Advisors Capital Management. Joanne, what do you make of the fact that even disappointments aren't being punished all that much, that the bar has been so lowered, and that early signs show that companies are stepping over it during this earnings period?
You know, Lisa, I think it's might be a pause this time around, giving companies a little bit of leeway here as we head through the end of this year. I think the worries are going to come for next year. So, the expectations starting the year were so dismal. We're going to end up in a recession and margins were going to compress. What we've seen is companies actually being able to work through some of the inventory problems they started the year with, and then in this back half of the year, turning in some pretty decent numbers. Heading into the holiday season, we're seeing Amazon hire more than we would have expected, and the consumer is holding up pretty well. And look at that labor market. More people are getting jobs, and fewer people are getting fired.
What do you do index versus active? I mean, I got an actively managed portfolio of 7 stocks is sort of where we are at right now. How do you tilt on spread it out versus concentration in sectors?
Yeah, owning the index is so concentrated right now, and it really puts folks in a really vulnerable position if that's where they are, because basically, as you said, Tom, they're owning 7 stocks. And, we don't like to do that for our clients. So we select 40 to 50 stocks, depending on, the style, depends on what their objectives are. And that's where you don't have to be exposed. Tesla's a good example. We really view that as a margin risk story. We agree that they're an auto company, not a tech company, and their margins are going to have to compress. That's an example of something potentially to avoid. And so you want to pick your places and you want to be diversified. And while you might look back and say, well, I wish I had owned those 7 stocks and that's all I wish I had owned, you may not feel that way for the next year or two. And all I have to do is remind people of what happened in 1999 and 2000.
Off a ratio analysis, where in the income statement, if you have 50 stocks and you got 7 chosen, my quick math is, Lisa, help me here, that's 43 stocks I got to go find. Where in the income statement, the cash flow statement, is the determinant of those 43 other stocks?
Well, those statements are a nice snapshot of what the company has just done. But what you actually want to do also is to look at what the company may do for the next few years. And so you have to go beyond the company's financial statements and look at what their end markets are doing. So if it's a tech company, you look at the shape of not just end markets these days, but also politics these days to factor that in. But, a starting point is that balance sheet. How secured are they in their cash position? Can they ride out a recession, for example? So that's, certainly one way to look at that snapshot. But more importantly is to look to the future and see what they can generate. Are they covering their dividend? Another reason to look at the cash flow statement, for example. So you want to look at the quality by looking at those snapshots, but then you want to look to the indicators of the future to see what the best thing is to hold going forward.
Joanne, can you translate some of these big picture, longer term concepts into the near term drama over the past 2 weeks where everything seems to have changed in the Middle East? How in the past 2 weeks have you shifted any of your views, if at all?
Yeah, so, the past 2 weeks, the rise of geopolitical risks that we've seen is something we have been talking about for a long time. It's been on our list, whether it's Europe and Ukraine, China and Taiwan. We've always mentioned the Middle East as a potential flashpoint. What has changed, though, is probably most directly for the U.S., a rise in our military budget. And I think that's one of the reasons, by the way, why we're seeing an increase in interest rates, is in recognition that the U.S. is going to be spending more, that the deficits are going to be sustained or grow, and that also, by the way, we have this dysfunctional government, which could put at risk the normal operations of raising the money to fund the military and other activities. So I think the biggest, most concrete implication of the last 2 weeks for the U.S. is the budgetary implications. And then obviously the risk of this spreading more broadly, creates risk to the normal economic order. So we have always owned defense industry companies, for example, in most of our strategies to provide some buffer against that kind of a risk. They tend to do well when these flashpoints kick in.
The reason why I ask that is because it seems like the world is moving very fast for us who have to cover it and give narrative to all of the movements every day. But most of the investors who we speak to seem to be sticking to broader, longer-term themes and not making a quick allocation shift of current events.
Well, I think if things really spread beyond the current conflict, for example, and there was an active war with Iran, right? Obviously, that would change the oil outlook. We might end up with more exposure to oil than we otherwise would. How would higher energy prices affect our other holdings, for example? Higher costs of doing business comes from higher energy prices. Right now, energy prices are fairly moderate. That could change the outlook. Also, a broader war could spread us into a longer period of adjustment.
Joanne, thank you so much. Joanne Feeney with us, Advisors Capital Management, today, here with this bond market move that we're seeing. Lisa, I've been looking at some of the tried and true bond portfolios out there, and I've gotten a huge response from this morning. Thanks for the emails. This basic idea that everybody's looking out to the future, which I get, but when equity markets crater, we look at the crater, and we sort of say, like, okay, here's where we are, what are we going to do? And I see this huge ignorance of price down, yield up. I'm looking at a major famous fund. Doesn't matter what it is, 27%, full faith and credit, 20. It's spread out. It's a carefully balanced portfolio. You ready? 15% in cash, because they're just waiting. Usually it's 4 or 5% cash. They're waiting to go in.
Or cash is just simply a better investment. They're yielding more than any other major fixed income asset class out there, at least so far this year.
We're going to follow this as much as we can. This bond debacle, it'll be a huge theme for us. And of course, Oliver Crook is in Israel as we continue to watch the Eastern Mediterranean. We will watch at 12 noon today our David Weston in conversation with the chairman of the Federal Reserve Board. Stay with us. This is Bloomberg.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industry.
talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg.
Live from New York City this morning. Good morning, good morning. Your equity market positive by 0.2% on the S&P, and the economic data looking good. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, the labor market data looking rock solid. Bond yields climbing to multi-decade highs, looking to the Fed chief to address Wall Street. We begin with the big issue. It's over to you, Chair Powell.
Powell is obviously the most important voice to listen to.
Hopefully we get a little bit more clarity from Powell.
I think he'll be fairly hawkish.
More information coming out of Fed Chair Powell as to the intentions of the Fed.
We've read far too much into recent Fed speak.
The tenor of the comments from the Fed is, I'd say, shifted, become more hawkish.
The long end of the curve has done a lot of the work for the Feds.
Powell can point to that move and say, hey, look, the back end's doing a lot of work for us.
The rising bond yields that we've seen is doing some of their work for them. So if
the rationale for dialing it down just a touch is the huge backup in long-term yields.
Whether they hike or not in November or December.
The threat of another hike.
The Fed, I don't believe, is done.
Less inclined to hike further.
Our view is that they're probably done.
I think that the Fed is going to try to be quite patient, especially with real yields where they are.
It's the cumulative effect of all the tightening they've done already.
Joining us to discuss, JP Morgan's Priya Misra, BlackRock's Jean Pavan. Priya, let's get straight to it. This bond market sell-off, are these moves a substitute for further action from this Federal Reserve?
They absolutely are, but I think if you look at the recent data, we're not really seeing that in the data. So what the Fed, I think, is trying to do is buy time. I think they want to look for the data. I mean, the recession playbook is not working out. There's been significant rise in real rates. I mean, the entire COVID savings buffer seems to be largely gone, and yet the consumer continues to power away. So, I would argue that the setup for a recession is there, but how long does that take? Is that 6 months? Is that a year? Is that 2 months? I think we don't know. The market doesn't know that. The market's pricing the recession date, I think, much further out. But the Fed doesn't know either. And I think it's notable, the shift from the Fed over the last week. I think, Chair Powell's likely to emphasize that the market's done some work for the Fed, but are we restrictive enough? I think they don't know this, and which is why I think he's not going to take another hike off the table. But I think the urgency for the Fed to continue to hike, inflation is coming down. I think that urgency is just much less. So I think they're going to buy time, wait for December. if the data continues to power through, I think early next year we might be looking for more hikes. You know, why just stop at 125 basis point? But I think it's just too early for the Fed. So I expect another message of let's be cautious. We need to proceed carefully. There's been a very big tightening, in at least on the real rate side. I think they're waiting to see whether that filters through across overall financial conditions.
Big move in this bond market, though, over the last few months. Let's go through it together. 2-year, 5-year, 10-year, 30-year, all in the last 24 hours. Looking at new cycle highs. The 10-year at the moment up a couple of basis points to 493. Almost at 5% over the last few hours. Jean-Bernard, this is the question that Andrew Hollenhorst over at Citi is asking. How will this Fed weigh the recent data relative to this bond market sell-off?
Yeah, I think they're focused on the bond market sell-off, and I agree with a lot of what my colleague just said. But I think, you know, I don't think they know themselves how to what to make of this long-term rates backup. And I think as a result, we're going to be in a few months where we're going to see signals going in all directions. That's why we've now expect you know, high volatility, two-way moves on 10-year. You know, we've been underweight U.S. Treasuries on the long end for the last 3 years, and this week I've started to turn neutral. Not because we think rates will go higher over time, but I think now we're in a world where the Fed itself doesn't know what it's doing, so it doesn't know what to make of it. And so you've seen that through the speakers. I don't know what Chair Powell will say exactly, but I think they're concerned about like the long end getting out of control, and that's going to dominate over, in my mind, the recent data.
Yeah, just to echo that, I think it's important. We heard that from Neil Kashkari of the Minneapolis Federal Reserve. Priya, he was perplexed by the move. Do you think they've got a decent understanding of what's driving all of this?
You know, they look at bond market models and they argue it's term premium. If you look at why has term premium increased? Now, there has been a little bit more supply, but it's the buyers that have stepped away. And why have the buyers stepped away? Because we've heard from the Fed loud and clear, higher for longer. We've heard a Fed that's data dependent. Data inherently is lagging. The Fed is not really looking at forward-looking indicators. So I think the buyers, and, you know, we were buying early on in the move. And then once we broke those technical levels, we took a step back and said, we're going to need to wait to see where it settles down. I think we're nearing the peak, very hard to call the peak. But I think, you know, back to your question on what drove the move, I think it was, to a large extent, the buyers getting nervous. It's paid to wait all year. If you're sitting out in cash, you're earning, you know, 5.5%, 6%. And so why extend out the curve? The data has not supported it. Fed speak actually pushed back against it in September. I think the Fed is trying to undo some of that damage, but they haven't fully gotten there. I don't think the Fed understands how hawkish that September Fed meeting was, which I think took all the buyers and put them on the sidelines, and everyone decided we just wait, you know, hang out in cash.
PPI was hot, CPI a little hotter than expected, retail sales big upside surprise. Let's talk about jobless claims. Mike McKee has the data. Morning, Mike.
Morning, John. I think we were both kind of gobsmacked by what we saw today, even with a United Auto Workers strike. The reference period for October jobs came in at 198,000, and that is a decline from 211,000. It just keeps going lower and lower. And when you look at the ongoing jobless claims, the people who are still getting benefits, 1,734,000. That's a rise of only 34,000. It's the highest in 3 months, but historically very, very low. So jobless claims would tell the Fed, and it's the most recent indicator they have, that the labor market is still pretty tight and that there is still a lot of strength out there. So what do they do about it? That's kind of one of the big questions here, given that the data have come in stronger than expected. Now, when you look at what the Fed is going to be doing, we did have a little bit of a pop in November from 5.6% to 7.8% chance of a rate increase. That's not really a move. 34% still for the December meeting, but that's sort of hedging their bets at this point. The market's sort of leaning against any kind of Fed move by the end of the year. So it'll be very interesting to see what Jay Powell has to say, because as we mentioned, very strong growth. You've got the Atlanta Fed and now Bloomberg Economics now casts, both converging on the idea of about 5% growth for the third quarter. The consensus a little bit lower than that. That may come up as we get closer to the GDP report in another 2 weeks. So keep an eye on that, and then you have to ask the question, and maybe David Weston will, given these kind of strong numbers, why are you considering not raising rates? Is it because there are higher real rates, or because you think that your rates need to go up? How high is higher, and how long is longer if you're going to be higher for longer? What's out there that we should worry about? Commercial real estate, banks, recession? What happens to the economy next when we come out of this? Do we see interest rates go back down again? John Williams thinks so. And then, of course, since this is my hit, John, I'm throwing in a question I want David to ask. I'm not sure he's going to, but since we know Jay is a Dead fan, what's his favorite Dead song?
Okay, that's coming up a little bit later. Opening question might be key on a Grateful Dead. Mike, appreciate it. David Weston sitting down, fireside conversation, fireside chat, alongside Chairman Powell at the Economic Club of New York and noon Eastern. Do not miss that conversation. The Fed speak beyond Powell. Goolsby, Barr, Bostic, Harker, Loken. Rest of the week, Harker, Mester. Then quiet period. No more of that. We heard this from Governor Waller in the last 24 hours. I believe we can wait. The full quote, I believe we can wait, watch and see how the economy evolves before making definitive moves on the path of policy. It is too soon to tell. John, you alluded to this. The prudent monetary policy move now, going into November. Is it wait and then reset in December?
From my perspective, I'm not sure if waiting would be necessarily the prudent move, because prudence goes on both sides. The inflation story is not over, but they have the financial side that is now in front and center in their mind. I think they will see prudence as trying to see what is happening in terms of tightening financial condition. That's kind of the frame they're applying collectively. And I think they are concerned about what that's going to imply more broadly, and they haven't seen the impact. So I think they'll interpret prudence as, you know, a lot of tightening is being done for us. I personally not sure that's the case. I think this is about, you know, resetting to a new regime. We've been talking about that for a long time. I think we have a different view, I guess, on what's happening. But from their perspective, I think they'll interpret prudence as let's a bit wait and see.
Jean, you and the team have put out a new note on the tectonic shifts we're witnessing post-pandemic. Talk to me about that new regime. What we're witnessing right now. Is this the new normal, the old normal? What is it?
I think it's the new normal. I think we're in a, you know, one of the core features of this new regime, it was that we were expecting rates to reset higher. You know, the last decade was pretty abnormal. In some sense, the new regime is going back to something that's a bit more normal, but we don't. We think we're in this world. You know, a 5% 10-year yield makes sense in this world. I think you know, when you look at the next 5 years, this is what it's going to look like, and that leads to pretty profound adjustment. And that's why we talk about mega forces. We think for investors, the opportunities are probably more by harnessing what these mega forces will do, and one of them is like how does financial system really adjust this to this higher rate environment when we've made big change since 2008. There's been big fundamental change, the structure of the financial system, that we haven't seen the impact until the rates start to go up, and now we're starting to see that. I think the role of bank issuing credit is evolving. I think credit will have to come to other places in the financial system over time, and that's the kind of structural tectonic shift that I think we need to follow, harness, and where returns will be.
Priya, is that a view that you share?
So I would argue there were elements of 2008 to 2019 that were abnormal. But, you know, you look at a lot of other trends, productivity, demographics, I think inflation, a lot of these, we would argue, are still very much present. I mean, is the Fed going to be as aggressive? Are they going to take rates down to zero and do significant QE? I think it's going to take a pretty big shock to get there. So I do think there are elements of the pre-GFC world that are going to be more relevant. But I would still argue one of the things that's very hard to model is that the lags might actually be a lot longer. I know the Fed argues that the lags are shorter between monetary policy and the economy. I would argue the lags are much longer. You know, the fact that businesses, households, everyone termed out their debt. So if I'm locked in a low mortgage rate, well, the housing market's going to get frozen.
Yeah.
What breaks that will be ultimately either home prices have to fall or we get a recession. So I would argue that 5% is still attractive. When you're a flat curve, when cash is giving you 5% and the 5 years giving you 5%, I think extending duration and significantly looking at corporate balance sheets. I think that's active management is going to become really important because cost of capital is going to be higher in this new normal. I'm just not convinced that we're not going to go down in terms of rates from here.
Priya, I'm not convinced that we fully realised the shock associated with the rate move we've seen in the last 3 years. Just take a step back and think about what's happened. In the space of 3 years, we've had yields at multi-decade highs and the lowest rates ever in the space of 3 years. And I was looking at a long gilt, 30-year issued back in 2020. When that was issued, look at the move we've had since then. A move of something like 50 to 60% lower in price. Priya, can we go back over something you and I have touched on before? Have we fully realised the pain associated with the losses in bonds over the last few years?
I would argue not. No, I mean, I think fixed income portfolio managers maybe, but if you're in the real economy, you know, you're a company that's termed out your debt, you're a household that is locked in a low mortgage rate, it's just going to take a while. At some point, you move your home and you have to then deal with a 8% mortgage rate, or you have to refinance your debt. I think, you know, everyone's been hoping for interest rates to fall next year. If the Fed is not going to cut rates next year, and if the 10-year is going to stay at 5%, I think it's going to start to impact. I think the hard thing for us is that a 6-month or a 1-year lag from here? And I think we have to sort of live through this period, start to think about how to position for, essentially to your point, where the real rate, and I would say it's not even just the nominal rate. Look at real rates. 2.5% real rate is a pre-GFC average, or on the higher end of the average. So I would argue, you know, that pain of high real rates will be felt over time. You just have to sort of survive this period while that pain is still not being felt.
Jean Bavin, how are you thinking about the same thing?
Well, the first thing I would say is, you know, and we've talked about that a few times on this show, John, is we don't think this is an expansion. This is not a cycle, right? This is, we've been restarting. I think that's the lens that changes everything. I mean, even when you look at the tightness of the labor market, it's tight, it's not strong in our view. We're adjusting to a new structural reality. And that's taking some time. So that's the first point. I think when I think about rates and long-term rates in particular from here, I think I want to distinguish between what's going to happen to the risk-free rate or the policy rate. They won't stay at the level that they are for the next 5 years. So I agree with Priya that that's likely to at some point require some adjustment. But that doesn't mean that the 10-year is going to go down. I think there's a term premium, there's a compensation for holding duration that investors are clearly living through over the last 3 years. The volatility is just like completely surreal. And when you experience that, there's going to be an ongoing kind of term premium that's going to have to reappear. So I think you get to a place where, you know, real rate can go down, and at the same time, long-term rates can stay around 5 because there's going to be a need for greater compensation for holding that duration.
Priya, what's your response to that?
I would say when risk-free rates rise or treasury rates rise, it's a tightening in conditions across the board. So do bonds come back as a diversifier? I would argue once the Fed is done, if the economic data starts to weaken, risk assets start to struggle, that term premium that seems to be breaking out starts to come back down, because now I want to be in 10-year treasuries over the stock market or over, you know, high yield credit, private credit. So I would argue there's a cyclical component to term premium as well. So that compensation for duration starts to go down if the economy starts to weaken and risk assets start to struggle. So that diversifier aspect can be an offset. So the front end, I still prefer the 5-year over the 10-year because we still haven't seen enough in the data. But if the data starts to turn, I think that compensation starts to go down because you really want to be in that risk-free 10-year treasury.
Priya, Jean, thoughtful stuff on a bond market. Priya Misra, Jean Bavin on the latest on bonds. We have seen cycle highs on a 2-year, 5-year, 10-year, 30-year yield, all in the last 24 hours. Right now, equities positive by 0.2%. Let's get you some movers. Here's Abby.
And beneath that relatively calm surface, John, we have some very big movers, starting out with the shares of Netflix. I believe that we're looking at the best potential day since January of 2021. Shares are absolutely soaring, and actually now we might be higher than those levels. But they added 8.76 million subscribers, one of the best quarters relative to subscriber adds in years. The password crackdown helping, and they're also going to be raising some prices in some areas. VMware down on a report from the FT that China is working to hold up its potential $61 billion buyout by Broadcom. And then Tesla, the other big tech mover, to the downside, down 6.6%. They, of course, missed earnings and revenues, earnings by 10%, margins below what had been set by as a floor by the previous CFO. The growth outlook also tempered on rising rates. So two different directions for those first two big tech company reports that we have out, John.
Abby, thank you very much. Coming up next, the latest on the president.
My ambassador's down there in Cairo now. He's going to coordinate this. He has my authority to do what is needed to get it done.
Team coverage up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
My goal was multifold, but basically to get humanitarian aid into Gaza. He agreed that what he would do is open the gate to do two things. One, let up to 20 trucks through to begin with. Satterfield, my ambassador's down there in Cairo now. He's going to coordinate this. He has my authority to do what is needed to get it done.
President Biden attempting to ensure aid enters Gaza, capping his quick trip to Israel with a primetime address from the Oval Office later this evening, discussing the attacks against Israel and the ongoing war against Ukraine. All this coming as the U.S. eases sanctions on Venezuela, lifting restrictions on the country's oil production in response to dramatic democratic developments and potentially an open election. Team coverage starts right now with Ollie Crook and Anne-Marie. Morning, Ollie.
Hey, John. Yeah, as you mentioned here, the focus really squarely is on aid. The UK Prime Minister is here. He's been talking to Benjamin Netanyahu, offering the same kind of support that we heard from Biden yesterday. But this question of aid, where everyone seems to say, OK, we're ready to move on this, and yet the aid is not moving. So that is going to be the #1 focus. In terms of the risk radar in the region, we should say that a number of Western countries are now warning their nationals that are inside of Lebanon to begin to prepare themselves for vacating. We've also had Hamas over the last couple hours calling for another day of rage. That is coming tomorrow. And then again, that sort of stop that did not happen in Jordan, where Biden was supposed to meet with Arab leaders. We're supposed to have an Arab leader summit this Saturday held in Egypt. So perhaps we can get a unified front there and a message from those leaders on how they think things should proceed.
MH, can he get a unified front at home in America, in Washington, within his own party?
Well, Jonathan, that's going to be the pitch this evening. The president will be giving a rare Oval Office address, really going into the homes of Americans, making this direct appeal. But, Jonathan, it's not just going to be about Israel, which we do note that there are some members, very left members of the progressive wing of the Democratic Party that are struggling with really the president's message on Israel. But he's also going to make a pitch about Ukraine and Putin's invasion of Ukraine and how the United States needs to fund the national security concerns of all their partners. We know that this is on potentially the heels of the president about to ask Congress for $100 billion in aid for Israel, Ukraine, also countries in the Indo-Pacific like Taiwan, as well as, Jonathan, security for the southern border. Given the fact that there's a lot of disagreement amongst a lot of these national security issues, especially when it comes to Ukraine and when the Republican Party, the White House is really going to cast a wide net, and hopefully with all of these issues in one bill, it can garner enough support.
AMH, and just to wrap things up, a really difficult poll for the President of the United States from us teaming up with Morning Consult. What's your read on that?
The read is that the president has a lot of work to do, even though we are more than a year out from next year's election. We really need to take the timeline into account here, but the president has a lot of work to do if he wants to remain in the White House come after next November's election in these swing states, especially, Jonathan, the fact that he won the majority of them. He has a lot of work to do when it comes to the economy. The economy ranked once again as #1 top of mind of voters, especially inflation, Jonathan, where voters just feel like it is eating into their disposable income.
AMH, thank you. The latest on the ground in Washington and over in Tel Aviv in Israel. Ollie, thank you to you, sir. Equities right now positive 0.1%. Up next, the morning calls, and later, Stifel's Barry Bannister says stocks peaked last summer. This conversation up next.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
Five minutes away from the opening bell. Stocks a little lower on a Russell, higher on the S&P by 1/10%. As the price action, here's some morning calls. First up, Cowen. Downgrading Canada Goose to market perform, seeing limited upside due to consumer headwinds. Your second call from Bank of America, downgrading Peloton to underperform, pointing to aging subscriptions and declining engagement. That stock down 5%. And finally, KeyBank, upgrading Netflix to overweight after earnings, expecting the company's paid sharing feature to boost subscribers throughout the next year. Coming up on this program, a tale of two tech earnings. Stifel's Barry Bannister discusses his outlook for big tech as earnings season gets underway. From New York, this is Bloomberg.
life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute, and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg.
25 seconds away from the opening bow this morning. Good morning to you. Pushing higher by 0.1% on the S&P 500. Tough day yesterday across the board for equities. On the Nasdaq this morning, bouncing back by 0.4. We'll talk about those numbers out of Netflix in just a moment. The opening bell in New York City rings. Switch at the board and get to the bond market. We look a little something like this on a 10-year. Yields up by 3 basis points. 4.9449. Very close to 5%. A little bit earlier in the session on a 2-year maturity, 5-year, 10-year, 30-year, take your pick, cycle highs across the board in the last 24 hours. In the FX market, the dollar's shown a touch of weakness even with those moves in the bond market. The euro 105.67, we're positive on that currency pair by 0.3%, and easing sanctions on crude production in Venezuela. Crude pulling back just a touch, down 1%, $87 and about 50 cents. About 30 seconds into this session, a lift on the S&P by 0.2%, on the Nasdaq by 0.3. One stock to watch at the open, Tesla. Shares under pressure after dialing back growth expectations due to higher interest rates and cautious consumers. Elon Musk saying this: Tesla is an incredibly capable ship. We're not going to sink, but even a great ship in a storm has challenges. Eduardo has more. Morning, Ed.
Good morning, John. This is a big drop in Tesla's shares. At this level, it's on track for the biggest decline since July, now trading at its lowest level since August. The story is that it is a difficult environment out there. And if you look at the sell side or analyst response, a number of firms have cut price targets. And of course, now starts the reevaluation for forecasts for 2024. But the read across between them is that expectations going into this quarter for Tesla were low. What came out in terms of financial results in the quarter gone was even lower than those low expectations. Adjusted EPS, 66 cents a share. The forecast was 74 cents. The story of the year has been price cuts, and we've seen how that's impacted the bottom line. On the top line, revenue of $23.4 billion was below the $24.06 billion in sales that analysts were expecting. But the key metric that you watch is automotive gross margin, excluding regulatory credits. That data point came in at 16.3%, which is the lowest level in 4 years, well below the sort of floor that previous CFO Zach Kirkhorn had put in place. And now starts the debate about valuing Tesla as a car company or as a technology company. Wall Street was looking for automotive gross, excluding reg credits, of 17.7%. I think you and I are going to talk later in the show about the bigger picture narrative from Musk, the growth trajectory. But this is a big move lower in Tesla, down 6%, biggest drop since July.
That valuation question is the question. Ed, thank you, sir. Down 5 or 6%, as Ed pointed out. Here's a view from the south side. Wedbush, Dan Ives, doing this, cutting the price target to 310. Here's the quote. We would characterize last night's conference call as a mini disaster. The street wanted to get their arms around the falling margins and constant price cuts. Instead, we heard from a much more cautious Musk, focusing on higher interest rates and the difficult path for Cybertruck production. The latest there from Dan Ives of Wedbush. The stock lower this morning. In early trading in the first 2-3 minutes of the session, down by something like 5 to 6%. We're down 5.3% currently. Your second story, in the other direction, Netflix raising prices after posting its best quarter for sub growth in years. The company writing this. We've shown that with discipline and a focus on the long term, you can build a strong, sustainable streaming business. Abby has more. Hey, Abby.
Hey, John. Investors really like what they've done with the past quarter and the outlook. The stock is soaring, having its best day right now since January of 2021 at the highs at the open, up 18% at that point, the best day since October of 2016. So a big reward here for these results. And what investors are really honing in on is the big subscriber add. 8.76 million subscribers were added in the third quarter, blowing out analyst estimates. And it's also one of the best quarters for subscriber adds in years. Now, why it is so important, it puts them on track to add 20 million subscribers this year. When you compare that to 9 million in 2022, well, it's more than a doubling. It shows that their password crackdown is working, and they're also saying that their strong content is really helping out the results, so much so that they have confidence to raise prices, as you mentioned, by $3 to $23 for its big plan here in the U.S., the basic plan by $2 to $12. They will do similar raises in both the U.K. and France. A couple of analysts on the street, John, very excited and positive on this. Morgan Stanley upgrading the shares of Netflix to an overweight, also raising the price target to $4.75. Big upside there. And Truist upgrading to a buy. Netflix absolutely soaring on the day. Big results out of the streaming company.
396 in early trading and still climbing. Abby, thank you for that. Let's stick with earnings. Las Vegas Sands authorizing a $2 billion buyback program. The CEO saying this. We were pleased to see the recovery in travel and tourism spending. We remain deeply enthusiastic about our opportunities for growth in the years ahead. Katie has the story. Hey, Katie.
Hey, John. Yeah, there's two factors that's pushing Las Vegas Sands higher this morning. First, of course, the third quarter was a beat, but it's really that $2 billion share buyback that's really driving the stock higher this morning. This is the first buyback since 2020. And of course, this follows Las Vegas Sands reinstating its dividend last quarter, which had also been halted in 2020. So you take those two together, and it's really a clear signal of management's confidence here. You take a look at what the sell side is saying. Citi noted this morning that the buyback shows that management believes that where the stock is trading right now does not reflect the company's fundamentals, while Barclays called it, quote, a nice surprise, and noted that the third quarter results were better than feared. All of that clearly working through the shares this morning. You take a look right now, currently almost 4% higher, though I'll note it's still lower on the year, John.
Katie, thank you. Up to 46.26. Let's turn to the telecom space. AT&T raising its annual free cash flow guidance after topping mobile subscriber estimates. The CEO saying the following. We're gaining profitable customer relationships and becoming more efficient. This is powering our strong business performance. Simone Foxman has this one. Hey, Simone.
Hey, John. Yeah, the beat and raise here, driving shares up higher, the most since July on an intraday basis. A lot of the focus was around the full year cash flow outlook that it was able to increase. Now seeing a full year cash flow at about $16.5 billion versus the $16 billion that was anticipated. This speaking to the success of the company's cost-cutting program, also able to raise earning guidance here. All of this, though, on the back of those gains in subscribers. 468,000 net new mobile subscribers in the third quarter. That's well above estimates. And this after 4 consecutive quarters of declining subscriber growth. You know, there's a lot of competition and broader headwinds in the industry, especially AT&T just lagging the 5G network build-out that the likes of Verizon and T-Mobile have done. It has a heavy debt load, and we still don't know what the costs are going to be of cleaning out the lead from its old copper phone network. But Citi here saying this strong growth in postpaid subscribers is a positive net data point for the industry. We seem to be watching Verizon shares rally a little bit in sympathy. And this, mind you, is before the accounting for a lot of those iPhone subscription sales and promotions that we saw at the end of September. So maybe a little bit more positive news ahead, and that's why we're seeing this 6.4% jump.
Big gain. Simone, thank you. The latest about 7 minutes into the session. In the equity market, positive here by 0.1%. On the Nasdaq, up by about 0.2. In the bond market, plenty taking place. I've said this a few times today. Cycle high on a 2-year yield, on a 5-year, 10-year, 30-year, all of the past 24 hours. Currently, yields up at the long end, just a touch on a 30-year by a couple of basis points, call it 3 basis points higher, just north of 5% on a 10-year, getting closer and closer to that line in the sand over the last day or so. That 5% line, 4.94, yields up a couple of basis points right now. Stifel's Barry Bannister seeing limited upside for equities over the next 12 months, right in this. Our view remains that the S&P 500 peaked in the summer of 23 and see mid-4,000s through the middle of 2024. Barry, I'm pleased to say, joins us right now. Barry, fantastic to catch up, sir, as always. For people not familiar with your call, let's work through it together again. Why do you see that peak back in the summer and limited gains, muted price action for the year ahead?
Yeah, we got off the bullish train in the summer of 23. Our view is 4,400 at year-end this year, and it's actually new information. We think 4,400 all the way through the middle of 2024. The problem has always been the normalization of interest rates. If you look at the 10-year real yield, the Treasury Inflation-Protected Security, or TIPS yield, when it burst through 2,000, the market ran into through 2%, the market ran into trouble. It went to 2.5, and if you look at the TIPS yield equivalent for the 45 years prior to the year 2000, it was 3%. 2000 was a seminal year. It began 5 deflationary shocks in 20 years. Now the Fed is leaving that deflation behind. We're normalizing rates. If we go to a 3% TIPS yield, it keeps pressure on the price-earnings multiple of the market for a prolonged period of time.
Barry, is that a bigger problem for certain parts of the market versus others?
Yeah, sure. Long duration, what we call long duration equity or higher PE multiple growth stocks, their valuation suffers more as that real 10-year yield goes up, the TIPS. On your Bloomberg, it's USGG T10Y. And if you look at that yield going up, it's going to keep pressure all the way into next year, towards the middle of the year, when we have to start worrying about some of the economic data, possibly weakening, unemployment crossing over 4%. These would be precursors to recessionary concerns in the back half of 24.
So, Barry, back end of 24, to have those concerns, you're just pushing them out. Lots of people just pushing out these concerns to the back end of maybe next year. Barry, with that in mind, is there a window here to look for some kind of cyclical rebound that you can get exposure to in stocks?
Yeah, what we've been saying is essentially a pair trade. So long cyclical value, short cyclical growth. So what is that? Cyclical value is energy, capital goods, financials, transportation, materials. Cyclical growth, the short, would be things like media, entertainment, semiconductors, tech hardware, and autos. So that's Alphabet, Meta, NVIDIA, Apple, and Tesla. So you're long short on a cyclical basis. And what happens is you get a cyclical rebound. The PMI manufacturing, we think it goes over 50 soon. The industrial production has been strengthening, no recession on the cyclical side. And the other thing to consider is the sticky inflation. The precursors of inflation, like wages and commodities, they don't look so bad to us. We think that they'll stay aloft, no recessionary decline. So when you get that cyclical rebound, sticky bottoming for inflation, you really want to be in a more cyclical profile. And the growth stocks are just, continuously hammered by that rising real yield as the Fed normalizes the long end of the curve.
Barry, I was reading some of your work. You seem to acknowledge one threat to the cycle, energy. Is energy the hedge here for you?
Well, energy is kind of a call option on a tight market. The geopolitics have really filtered into energy. I mean, Saudi Arabia could decide tomorrow to bring the price of oil down, but they've chosen to keep it up. Now, $80 to $90 a barrel, they're probably satisfied. But if you poke up towards $100 a barrel, they could easily increase production and lower the price. So they're being rational actors here in terms of the way they're acting. The irrational side, the one we don't really understand, is what would happen in 2024 with Russia, maybe Iran, on the oil front. Remember, Russia has a presidential election, I believe it's March of 24, and we have one in November of 24. Peak summer driving season is the summer of 24. Their best option from a game theory perspective would be to cause oil to skyrocket into the summer and fall of 24. So higher oil prices with energy stocks is a little bit of a call option on that, not to mention that it's just a sort of a cyclical group right now because it's a demand story relative to supply.
Hey, Barry, good to get your views and an update from you and the team. Barry Bannister there at Stifel. We're about 12 or 13 minutes into the session. I just want to mention where crude is. Brent 90.84, WTI 87.69, negative by about 0.7%. Coming up, Tesla earnings missing the mark.
Tesla had a disproportionately large share of the market because it did have first mover advantage. But first mover advantage does not last forever.
Pierre Ferragut of New Street Research joins us next with more on Tesla's disappointing quarter. A conversation coming up.
Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Do you see a future for Monumental as a public company?
Yeah, I think so. I think what we found is the leagues have opened up to new pools of capital. Over the last year or two, both the NBA and NHL have allowed professional investors to come in, not as individual owners, but as funds. So that's a whole new pool of capital that didn't exist before. Sort of shows a whole new asset class opening up for professional sports, not just teams, but professional sports enterprises.
I think the sophisticated analysts will be looking at this industry, and as our revenues start to get in the billions of dollars, yeah, I think that you'll see a wave of companies go public. Whether we will or not, there's a big responsibility when you're a public company. And I tell people, we're a public company already. The scrutiny that you're under in running a sports team is, I think, much higher than a public company CEO has to live with. We'd be prepared to do it. Just the market would have to be right. We'd have to emotionally be ready to do something like that. But I think Monumental will be one of the 3, 4, 5 best-in-class organizations that, if that time was there, sure, we could go public.
There are a lot of other car companies out there that can make electric vehicles, and Tesla had a disproportionately large share of the market because it did have first mover advantage. But first mover advantage does not last forever. It does not afford a permanent competitive advantage. You got to keep running to stay ahead because people are coming after you. And what we're seeing is that the competition is catching up. And Tesla is forced to lower prices and deal with lower margins, just like other car companies.
Tesla earnings missing estimates. The CEO, Elon Musk, discussing some of the challenges, saying this: we dug our own grave with the Cybertruck. Special products that come along only once in a long while are just incredibly difficult to bring to market and to be prosperous. Ed Ludlow has more. Hey, Ed.
Yeah, there's a lot long-term to recalculate and reconfigure here. Interest rates was very much top of mind for Elon Musk. To give a specific example of how that manifests itself, Tesla has plans to build a new factory in northern Mexico in Monterrey. And what Elon Musk said is that they will sort of decelerate that process. They cannot go full tilt, is how he put it, and that expansion generally will pick up pace if and when interest rates decline. It's one of these things where suddenly you have market analysts going back to looking at the dot plot and Fed futures funds to work out, Fed fund futures to work out, you know, what the trajectory is for this company. In terms of their response, right, a lot of focus, as we discussed, on automotive gross margin, excluding regulatory credits, coming in at the lowest level in 4 years. They are focusing on cost-cutting internally, according to the engineering chief, Lars Morave. And then there's the biting off more than you can chew element, right? The Cybertruck is already 2 years delayed. It will ship starting November 30th, but it's going to take a period of 2 years, according to Musk, into 2025 till they're shipping at volume. A lot of narrative out there about how bad this earnings call was from an investor's perspective, going back to sort of 2018 times. A lot of people focusing as well that Zach Kirkhorn's departure as CFO is now more of a concern. That's a really interesting question to pose to some investors out there.
Ed, thank you, mate. Appreciate your coverage over the last 24 hours. Pierre Ferragu of New Street Research joins us now. Cut the price target down to 300, maintaining that buy rating. Pierre, let's get straight to it. Given the direction of margins and where things are heading right now, the question I hear a lot this morning, Pierre, how to value this company? Like any other automaker, what is it?
Yeah, it's a very good question. So if you look at the last 12 months, Tesla reduced its average selling price, so you can roughly translate that into cut prices by a bit more than 15%. Gross margins came down by just over 10 points. So that's definitely a painful journey, let's face it. What's interesting is that it's not so much a question of competition or anything like that. I hear a lot of comments around that. I think it's very misinformed comments. The only reason why Tesla has been cutting prices that aggressively is because you have less people buying cars, and it's an elastic market, and so you need to reduce prices, not because your competitors are hurting you or taking share from you, but because you want to continue to grow and find buyers. So what's interesting in this math, you know, you take prices down 16% and you have your gross margin coming down 10%. That means underlying that you took your cost down by 4 points, 4% average cost per car and cost of goods sold. And that's really what's happening. So Tesla is cutting prices much faster than they can reduce cost. But the good thing is that these price cuts, they'll find a bottom at some point. And what maybe the company kind of like, you know, telegram last night is we're going to see a stabilization, and if we slow down our growth, that's all right in the end. And the thing is that when prices start slowing down, like the price decline starts slowing down, I think like the underlying cost cut, you know, 4 points a year, 1 point a quarter, is extremely sustainable. And this is really what maintains Tesla is in a unique position in the market, because they really have an ability by introducing their new batteries, their new form factors, their new manufacturing technologies at a pace that is unprecedented in the industry. They have the ability to maintain their cost leadership and improve it over time. And so to answer your question, sorry, it's a long-winded answer.
No, it's okay.
like
it's a big question.
Ultimately, Tesla will get back, you know, between 20 and 25% gross margin in autos. And when you're asking, you know, how do you value them? I, you know, take the revenues today. I plug in like a 22.5% gross margin. I look at what kind of earnings that reflects in 2024, and I'm looking at the multiple on that. And $300, it's 40 times that. So it's a very safe valuation. You know, paying 40 times earnings, normalized earnings for a business growing very fast, I think is a good, like, you know, low end of the valuation range. And that's where I think the stock is going to trade for some time, because it will take time, you know, for hopefully interest rates to come down, or consumers to adjust to it and come back to the market with like the new reality of how much it costs to own a car, or more time for prices to come down even more to really trigger that increased adoption. But on the fundamental story, the fact that Tesla is a massive cost leader and a massive product leader in the auto industry, and that where they still have like single-digit market share, it's still there. So it's still a very good growth business, and a business that has an extremely strong and defensible right to make money in this industry. So,
I've got about a minute left, Pierre, so I want to squeeze another question in if I can. No, by all means, I think it's the question. There isn't really any other. But I do want to talk about demand for EVs right now. Pierre, what is going on at the moment? You hear about all these unsold EVs piling up elsewhere. What is happening? What's your read on things?
Yeah, I think like Elon articulated that very well last night. When you look at how much interest rates have grown, like the total cost of ownership of a car today for like normal people who have to pay on a monthly basis for their car through a loan or a lease, has gone through the roof. And if anything, I'm surprised the broader auto market is not suffering more than it is today. And I expect the broader auto market to be like more and more disappointing demand. The reason why we haven't seen that much of a broad pullback in autos is because we've been running very, very low on dealer inventories and things like that. So the industry is readjusting to that.
It looks brutal. Pierre, they're screaming at me.
Gotta
go. I'm going to save more time for this conversation next time. Pierre Ferragut on the latest with Tesla. That stock is lower from New York. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From New York, here's the training diary. Fed Chair Jay Powell speaks at noon Eastern. Goolsbee, Barr, Bostic, Harker, Logan speak later. The House expected to hold a third vote for the speakership, and President Biden addressing the nation at 8 p.m. Eastern Time. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rating World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries? Soft landing, hard landing, no landing? I don't know. True. What the heck does that mean? I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Hillary Kausman, professor at the University of Colorado Boulder. She's going to join us to offer her perspective on the Israeli-Hamas war, its geopolitical implications, and the global diplomatic efforts underway there. So we're going to get to the latest. And we're going to get the latest on the markets here. We had some economic data came out today. Initial jobless claims a little bit better than expected. We'll break that down. The leading index came out, and it was weaker than expected. So we're going to break down some of those eco data points which are impacting the markets. But first, let's kick things off and get a market check with Denise Pellegrini.
Hey there, Paul. It's 10:01 on Wall Street. We do check the markets for you all day long at Bloomberg. It's been up and down for the Dow. A little bit of confusion, maybe. We do have that positive data, negative data as well. You mentioned the jobless claims. That puts one in the tally market for no rate hike from the Fed, right? At the same time, that LEI is down 0.7%, more than the 0.4% expected. Also, we had some, you might call it better than expected numbers on existing home sales. Existing home sales for September falling, but not as much as expected in spite of that 8% mortgage that we were just talking about. And we will be hearing from the man himself, Fed Chair Jay Powell, in just a couple of hours. A sit down at the Economic Club of New York with our David Weston. Right now, going into that, the Dow down fractionally, down 10 points. The S&P 500 up fractionally, up 3 points. The NASDAQ up 0.2%, 21 points. Yield on the 10-year, drum roll, 4.93% right now. We'll be watching it all day for you. Spot gold right now is better by 0.3%, $19.53 an ounce. We'll call it. Crude oil lower today after yesterday's big move up, down 0.9% at $87.56 a barrel. Netflix among the gainers. Streaming service raising prices for customers, as we've been talking about, posting its best quarter for subscriber growth in years. That stock is up just about 16% right now. And that is a Bloomberg Business Flash. Back over to you guys.
All right, Denise Pellegrini, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live as well on YouTube. So head over to youtube.com and search Bloomberg Radio. Lots going on here today, Matt. Lots of economic data coming out.
I have goosebumps right now.
Nice.
You know why? As Tom was leaving the studio, he mentioned a Bricklin car from the 1970s, and I feel like I know everything about cars.
Yeah.
I have never seen this. I had never even heard of it. It looks kind of like a Corvette, but it has like a really weird front bumper. The reason we're talking about it is because Tesla, because Elon Musk has complained that it's so difficult to make the Cybertruck.
Yeah, I don't know.
And
what's
he
going
says
on.
like it's a one-off, it's a special, vehicle, and we can't do it like we do with a normal production vehicle. I don't understand why. Just because it's shaped differently. I mean, a lot of people want the Cybertruck. They've gotten so many orders.
Really?
Why don't they just jack it up and make it a true production vehicle? I don't get why it's so difficult for them.
Yeah, all right. I can't imagine. It's the oddest looking vehicle I've ever seen. I'm not sure that I would have any interest in it. All right, let's start breaking down what we're seeing in these markets here. We're joined by Bailey Lipschultz. He covers the equity markets for Bloomberg News. He joins us here in studio. And we want to start with Dana Peterson, the chief economist at the Conference Board. Dana, thanks so much for joining us here. The leading index you guys reported today came in at negative 0.7%. The consensus was negative 0.4%, so a little bit weaker there. What are you seeing out there in your data?
Well, the data continue to say that there is a recession around the corner. We've been waiting for this quarter for a long time, but the index has been negative for 18 consecutive months.
Wow.
And in the month, in October, every indicator with the exception of jobless claims was negative and contributed negatively to the index. So it's telling us something bad is going to happen.
Well, I thought the Atlanta Fed is telling us we got like a 5% GDP number out there. I just can't square it here. Where
5.4%.
5.4%.
But that's for Q3.
Okay.
Right? And we're
that's
already
Q3.
in Q4.
So what are the cross currents out there, Dana?
Yeah, I think the issue is that monetary policy takes a long time to bake in to the economy and filter through everything. So it's already impacted the housing market. We saw that last year. We're continuing to see it this year. Businesses have pulled back a little bit away from spending on factories. But it's the consumer. Consumers continue to spend. We saw that in the September retail sales. Yes, we're going to get a big number for GDP for the third quarter, but looking out ahead into the fourth quarter and into the first half of next year, consumers are not going to see the biggest large gains in wages. They're going to run out of that excess savings, and they're also going to be paying more for student loans and paying down their credit card debt. All those things suggest that consumer spending is going to slow and that the economy is going to slow in general in the first half of the year.
So how concerned do you think the Fed should be? How concerned should Jerome Powell be that financial conditions are finally tightening the way they want them to be? Rates are soaring at a time when we're on the precipice of this, at a time when the federal government is raising spending. Like, it all seems to be coming together.
Well, the Fed, Chair Powell last year said, look, the Fed is prepared for some pain, quote unquote, meaning there could be some layoffs, there could be weakening the economy, and even a mild recession. And so that's all within expectations for the Fed. The key thing is that inflation gauges are still too high. We're still seeing outsized gains in payrolls, and wages, even though they've slowed, they're still quite elevated. And I think that gives the Fed fuel for the fire in terms of raising rates at least one more time, maybe even two if the data don't cooperate. But the key thing is they need to slow the economy so that inflation slows. If inflation doesn't slow down, it becomes baked into people's expectations, and that's a worse scenario.
Yep, absolutely. All right, Dana, thanks so much for joining us. Really appreciate getting a couple minutes of your time. Dana Peterson, chief economist at the Conference Board. Bailey Lipschultz, he follows the equity markets for us here today for Bloomberg News, and he joins us here in our studio. Bailey, kind of a mixed bag out there. Some red, some green. What are you making of it?
Yeah, a lot of earnings, a lot of movers. You're looking at Tesla down, as Denise mentioned, more than 7.5%. Netflix up close to 16%.
Just smoking numbers last night.
Which, I mean, it kind of makes sense, right? If you're going to hike prices and crack down on password sharing, people have to pay up.
Yeah, I was looking at some research from Michael Nathanson, one of my favorite analysts on the street. I think one of the best media analysts out there from MoffettNathanson. He was saying, boy, they did it all. They raised subscribers numbers, added more subscribers, and maybe not password sharing, And they were able to announce price increases, and they didn't lose anybody, really. So it's kind of, they got the best of both worlds from a revenue perspective.
Yeah, especially after, that was much needed after they saw growth slowing and turning negative at one point.
I'd say just in my household, I think the 4 Sweeney offspring, they were,
they were all stealing your password.
They were shocked, I think, when the emails came flooding in. Dad, what happened?
And do they all have their own Netflix accounts now?
I think a couple of them do. And the young one who's just in college, we're still trying to work something out.
So this is what, I was talking to Mark Douglas. I was talking to Mark Douglas from Mountain about this yesterday on TV, and he said basically password sharing was essentially like a revenue backlog.
Yes.
That they could access at any time. He's been saying that for a long time, but you're actually seeing that come true. He's a very smart guy.
Yep.
And they also rolled out the ad tier, too, which is similar to Hulu. So if you don't want to pay as much money, you can get advertisements. Excuse me. So a lot going on. Also, AT&T up 6.8%. Cash flow outlook looking great. Sales gaining, earnings beating expectations. A much-needed win for that stock. Ticker T, again, one of the handful of single...
Okay, but here's the story about our good friends at T. Okay, debt. They have $165 billion of debt on the balance sheet, and how much EBITDA? And how much EBITDA do they have? 40. So they got a lot of EBITDA, but they got a lot of debt, and investors want to see them reduce that debt load, and they have. There was like 200 billion at the end of 21, but they got some ways to go there. So
well, the good news is. And by the way, here's an opportunity to use a fantastic Bloomberg function. Okay. I learned about this function like when I was first hired.
Okay.
Rado Grigori, who's our, Rado Grigori, our deputy editor-in-chief, he hired me in Frankfurt 23 years ago, and I can't remember what, I think it was Deutsche Telekom we were looking at, and he sat me down and he said, do you realize how much debt they have? And do you know when it's coming due? And I said, no. And he said, type DDIS into the terminal. So you can do this with telephone as well. Just type T, equity, DDIS.
Debt distribution.
Yeah, and you can see all that debt, and you can see when it's coming due. Now, a ton of it isn't coming due until 2054. And
but 2027 is a big year, too.
Yeah, there's some big years in there, but the weighted average fixed coupon is 3.84%.
Yeah, how good is that?
Yeah, so it's, it could be worse.
Could be worse.
Is my
That's
point.
A good point. Very good
telephone.
point.
I think I would do a lot of things for that kind of a rate.
Well, if I'm a banker, I say, ooh, there's a lot of balance sheet management I can do for these people. Let's go and refinance some of this stuff. Let's term some of this stuff out.
This is what I don't understand. Refinancings now I don't get. There was a story yesterday about South Park. Yeah. Those two guys, Trey and Matt, they have refinanced like a $600 million loan with an $800 million loan now. And their $600 million loan was from 2021. Now they've refinanced it with an $800 million loan from now. Which is like, why?
Maybe, I don't know, maybe it was due like tomorrow or something, so they had to refinance
I mean, maybe, but it's like you had 0% and now you're paying 8. Like, that's not cool.
That's not cool.
I really need to go to Casa Bonita, by the way. That you should have done that when you were in Colorado, dude. Yeah. That's their restaurant that they bought.
Oh, okay. All right.
I think it's in Boulder or Denver, one of the...
All right, speaking of that, we're going to go there right now. Bailey, thanks so much for joining us. Really appreciate it. We want to get the latest on what's happening in Israel. Hillary Kalsman, professor at the University of Colorado, Boulder.
No, she may have been to Casa Bonita.
Could have been.
Let's ask her before we get into the Middle East situation.
Okay, go.
Because I don't want to, because it's such a tragic and horrible situation that we don't want to be at all lighthearted. But before we get there, have you been to Casa Bonita?
I have not. I've driven past it many times, though.
All right, and
I would like to go, but I think it's hard to get there right now.
I have another good recommendation for you. I just went this weekend. My son, who graduated from the University of Colorado, he picked, I think, the most expensive restaurant in Denver, Fruition. So I recommend Fruition if you haven't been there. All right, Hillary, let's get to Israel here. Very, very difficult situation here. Do you have a sense of how this might play out? I mean, it's just been on and on and on, and now with the horrific attack from, now 10 days ago, it's taken a whole new level here. Do you have any sense of how this might develop over the coming weeks and months?
It's a difficult question, and I would say I don't necessarily see any kind of long-term easing of the conflict either. It's something where you have an Israeli government reeling from intelligence failures, trying to figure out what is the best option while trying to kind of trying to reassure their constituents that they can in fact protect their citizens. On the other hand, their tactics so far have been, it seems, quite ineffective and causing a lot of civilian deaths within Gaza. So I do think a ground invasion is imminent. I think the part that I worry about in particular is what is the end game for any of the involved parties here?
So if you're the Palestinians, can you give us, just educate us a little bit here, to what extent do the Palestinian people in that region support Hamas?
Well, so Hamas was elected in 2006. Over, sort of about 50% of the population in Gaza would not have been old enough to elect them. And I would say I haven't heard sort of very many people supporting Hamas's current actions and also their fallout, right? It's something though where Hamas, so it's been a long time since 2006, right?
Yep.
And you've had Palestinians in Gaza, in particular, also in the West Bank, protesting, sort of demanding that their self-determination not continue to be put on the back burner, that their material conditions improve. In 2018, you had this great March of Return where you had Palestinians protesting daily at the border fence with Gaza. And it had no effect. Many of them were killed. So it's something where the Palestinians living in those areas, the Palestinians living in Gaza, I don't think have seen any tangible benefits from Hamas as a government, and they're certainly not seeing any tangible benefits from Hamas acting as it has been historically as a terrorist organization.
Did they see any tangible benefits from the PLO, the PLA? Have they seen any tangible benefits from help out of Jordan or Egypt? I mean, has anything been helpful to the Palestinians since like 1948?
I would say there have been periods where things have been better. The period, so between 1948 and 1967, the West Bank in particular belonged to Jordan, right? Jordan annexed it, including East Jerusalem. And Palestinians were made citizens. Now, again, many were extremely angry. The King of Jordan gets assassinated for agreeing to sort of work with Israel in 1948. And Gaza is occupied by Egypt, but Egypt doesn't want to annex it. It doesn't want to make it part of Egypt. It doesn't want that Palestinian population. That said, during that period, you are able to have, sort of Palestinians beginning to kind of build up a livelihood again. But I want to emphasize they don't have Palestinian sovereignty. They don't have a state. And one of the other things to remember, right, is that the Palestinian population, without a state, without a standing army, without even, sort of the ability to collect their own taxes. And again, this worsens under Israeli occupation after the War of 1967. You have essentially, again, sort of their self-determination postponed. And and they also have sort of very little bargaining power vis-a-vis the Israeli state. The periods in which they are able to get bargaining power are periods in which they make it harder for Israel to continue the situation of having Palestinians without a state and continuing to occupy them.
Yeah, this is...
No, please continue.
Just 30 seconds left, Professor. Is there anywhere for Palestinians to go in this world? I mean, what do they do?
It's so hard. And again, it is so many ordinary people who would like to live somewhere in safety with their children. And one of the things I really want to emphasize here is that the future safety of Israel also depends on there being somewhere for Palestinians to go and be safe.
Yep.
They're entwined. And I think the the Hamas terrorist attacks are a horrible, unjustified wake-up call for the Israeli government to sort of say, no, like, you cannot keep your population safe with this Palestinian population without statehood
Right, I understand.
next to you.
All right, Professor, thank you so much. We appreciate that. Hillary Kallisman, she's a professor at the University of Colorado at Boulder, giving us some historical perspective here on this brutally difficult part of the world. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, Netflix shares are soaring more than 16% after the streaming service announced it's raising prices again. More from Bloomberg's Joan Doniger.
Steve, the price hike for some customers in the U.S., UK, and France comes after the streamer posted its best quarter for subscriber growth in years. Netflix said it added more than 8.7 million customers in the quarter. The company credits strong programming and the crackdown on password sharing for that jump. Investors have worried Netflix might lose customers if it forced people who were sharing accounts to buy their own subscriptions. But the crackdown has led to a surge in new customers without a major increase in cancellations. Steve?
Thanks, Joan. More job cuts at Ford as the United Auto Workers strike drags on. The latest from Bloomberg's Scott Carr.
Ford says it's laying off another 150 workers in Michigan because of the ongoing UAW strike. That brings the company's total of workers furloughed to 2,730. Ford says the UAW's walkout last week at its Kentucky truck plant prompted the new layoffs at a Michigan axle plant. The targeted strike against Ford, General Motors, and Chrysler parent Stellantis began September 15th. Scott Carr, Bloomberg Radio.
Thanks, Scott. Ford stock is little changed this hour. Shares of AT&T are up after the company topped estimates for new customers and profit in the third quarter. The carrier says it added 468,000 new subscribers. AT&T also upped its full-year free cash flow to about $16.5 billion compared to earlier guidance of $16 billion or better. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 10:21 on Wall Street. We check the markets for you all day long here at Bloomberg. Stocks are mixed. Leading economic indicators down 0.7%. That is more than the 0.4% expected for the month. Existing home sales fell less than expected, but at the same time, when you put it in perspective, Bloomberg Hothead on the terminal right now, U.S. existing home sales sink to the lowest level since 2010. And if you remember, 2010 was a tough year for the housing market. We did also get those weekly jobless claims coming in at the lowest since January. That puts a tally mark, and the Fed won't raise interest rates at the coming meeting column, right? And we will be hearing from the man himself, Fed Chair Jay Powell. Just a couple of hours now, he'll be sitting down at the Economic Club of New York with our David Weston. We'll be carrying that live for you here on Bloomberg Radio. Rising Treasury yields kind of weighing on things today. The Dow now down 0.3%, down 89 points. The S&P 500 also taking a turn into the red now, just a little trip lower though, down 4 points, so that's down fractionally. And the NASDAQ, it's still, gaining ground a little bit. It's up about 0.1%, just up 15 points. That yield on the 10-year, 4.95% now, we'll call it. Spot gold right now, it's up by about 0.2%, $19.52 an ounce. Crude oil, it is lower today, down 0.8%, $87.63 a barrel. Netflix among the gainers, huge gain. Streaming service raising prices for some customers in the U.S. and also talking about its best quarter for subscriber growth in years. That share has been up just about 15% for much of the morning. And that is a Bloomberg Business Flash.
All right, Denise Pellegrini, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker studio streaming.
Netflix is killing it.
Monster numbers.
But look at Tesla. Down more than 8%.
I know, man. They got to build the trucks, I guess. I don't know. All right, here's, I think, one of the most fascinating stories on the Bloomberg terminal today. A Bloomberg News and Morning Consult poll provides one of the most detailed looks yet at how the 2024 presidential race is playing out in the 7 swing states that could decide who wins the title. The reporter on this story, Gregory Corti, joins us. He's a White House and political correspondent with Bloomberg News. Gregory, what's the poll telling us here?
Well, what this poll does, unlike a lot of the other polls you see out there, which are national polls, this just looks at the 7 swing states that are most likely to matter next year. And they are Arizona, Georgia, North Carolina, Pennsylvania, Michigan, Wisconsin, and Nevada. And what we see in this poll is that former President Trump is up in 5 of those 7 states. Biden is up in only 1. President Biden is leading in Nevada, and then Michigan is a dead tie, according to our poll. But across these, if you look across the swing states, former President Trump is overperforming what you see in the national polls, and obviously that's a good sign for him because these are the states that are actually going to matter.
So we're 13 months before the election. If I were the Biden re-election campaign, how would I interpret these numbers? How concerned would I be?
Oh, I think they're concerned, and they're very likely seeing similar kinds of things in their own internal polling. But they would also say, look, it's 13 months before the election. Certainly, we've had some economic challenges coming out of the pandemic. Inflation is ebbing somewhat, but people still feel it, absolutely. What we see in this poll is it's those kitchen table issues. It's those bread and butter household economics that is really killing the president right now. There's a huge trust deficit. Voters in these swing states are trusting former President Trump on the issue of the economy and all the sub-issues that we look at the economy. We really delve deep to look at, okay, when you talk about the economy, are you talking about inflation? Are you talking about the stock market? Are you talking about taxes or spending? And across all of those economic issues, President Trump had the advantage in these swing state voters. What President Biden is hoping is that as the economy improves, if we're able to have that soft landing and avoid the recession, if people are looking up by this time next year, more optimistic about where the economy is going and not just where it has been, there's an opportunity for President Biden to be reelected.
The problem is, I think, pretty clearly inflation. Yep. Like, even if inflation got down to 0 today, you've still seen prices run up at an unbelievable pace, and they're not turning around. Plus, wages have not kept up, even nearly with inflation.
Were wages now growing ahead of inflation?
No. I mean, I look obviously very closely at cars, and I just see Hannah was right. Hannah Elliott wrote a story about the Jeep 392 2 years ago, going for $74,000, and she thought that was way too expensive. I wrote about it, or I'm looking at it this week, and I see it at $92,500. So that's a huge jump. It's up 23%. And I guess my question, Gregory, is this: a lot of this is very clearly, inflation is very clearly being fueled by excess spending, which was understandable during COVID. but we're still running $1.5 trillion deficits. And President Biden is like all in favor of spending as much as possible, or at least that's how it appears, right? So how does he turn that narrative around, while we're looking at these huge deficits and debt?
Yeah, so what you've seen is, and I think you exactly nailed it, right? So even if there's a little bit of disinflation, that's not the same as deflation, right? So people have seen this cumulative inflation over the course of the Biden years. Again, we were coming out of a pandemic. A lot of this spending happened in the tail end of the Trump administration. Those arguments are falling on deaf ears. Republicans have branded this economy as Bidenomics, right? All this inflation that people are seeing.
Biden has branded this economy as Bidenomics.
Well, what President Biden has tried to do is rebrand it as this package of social spending and investment in green energy technologies, infrastructure, all of these things. But people are looking at the outputs and not the policy inputs. And so I think you're absolutely right. It's the economic indicators, but even more than that, just what people are feeling, that perception. And it's going to take a while to change perceptions because the cumulative inflation during the Biden years is more than 16%.
Wow.
It takes a while for people to digest that prices are now stabilizing a little bit. They still are comparing what they're spending now to what they were spending pre-pandemic.
Yeah, what I'm feeling is I can barely afford like groceries, childcare, and housing at a time when, if you want to buy a car, get ready for 8 or 9% interest rates on that.
Yep.
If you want to buy a house, ditto.
Yep,
with
exactly
the mortgage. Right. So it's like, and we're still going to say, hey, let's do a $1 trillion additional spending bill, right?
Exactly.
What?
So, Gregory, the president, we had some more news on some of his legal challenges today regarding one of his former aides pleading guilty. He still has a lot of legal challenges ahead of him. That doesn't seem to be hurting him at all, does it?
Yeah, I just saw that headline crossing the Bloomberg terminal as I was coming on here. What we saw in this poll was one of the interesting things is one of the questions we asked is, what have you seen, read, or heard about these candidates in the past few days or weeks? And it called for an open-ended response. So we got to see actually what they were hearing, how they were viewing these candidates. And what you heard a lot about President Biden, about his age. And what you heard overwhelmingly about President Trump is about his legal troubles. And interestingly, we heard it both from Democrats and Republicans. Trump supporters are talking a lot about his legal troubles. Of course, they're doing it in a different context. They're saying, all I hear about is President Trump's legal troubles. I wish I would hear less about it. Everybody's fixated on it. This is all sort of a witch hunt. But it's certainly, that news is permeating. People are reading it. And they're reading it on a more granular level than I expected. When former President Trump is hit with a gag order, people mention that gag order. They're following some of the micro developments of this. So it really is capturing people's attention. But the partisanship is just so entrenched that it's not moving those numbers. And the economic issues, as we're seeing in this swing states poll, are dwarfing everything else that people know about these candidates.
Doesn't the Democratic Party... doesn't the DNC need to do more to boost Kamala Harris's profile? Because if you're worried about President Biden's age, without discussing whether or not that's a valid concern, you've got to feel comfortable with the vice president. Because in that case, you're casting a vote not just for President Biden, but it's, I guess if you're worried about his age, it's likely that you must think Kamala Harris could eventually take that spot over.
Yeah, we asked this question in this swing states poll, and a majority of voters said that the vice presidential pick is more important this year than it has been in the past. For Democrats, 30% said it was much more important who the vice president is because of the age of these candidates. A little bit less, maybe 24% for Republican voters said the vice presidential pick is more important. Of course, we don't know who President Trump, assuming he's a nominee, we don't know who his running mate will be. It will be almost certainly someone other than Mike Pence, who was vice president in his first term. But yes, voters in both parties are more fixated on the vice presidency just because of the age of these two candidates.
All right, Gregory, thank you so much for joining us. Fascinating reporting here today. Gregory Corti, he is the White House and politics correspondent with Bloomberg News, and Bloomberg News, along with Morning Consult, did a pretty deep dive poll focusing on 7 swing states that could decide who wins the White House, and Trump leads Biden on the economy and on foreign policy. Those are the takeaways from that poll. So that's getting a lot of readership on the Bloomberg terminal here. Looking at these markets, a little bit of red on the screen here. The S&P 500 is off about 0.3%. The Dow's off about 0.4%, and NASDAQ off about 0.2%. So a little bit of red on the screen. Yields kind of steady here today. The 10-year's up about 3 basis points, 4.94% on your 10-year. Right now, let's head down to Washington, D.C. Amy Mars has got world and national news. Amy.
Thank you, Paul. The UN, the UK, and Germany all spearheading efforts to contain the conflict in Israel. Now, we will hear from President Biden tonight in a primetime Oval Office address. Bloomberg's Oliver Crook in Tel Aviv on what leaders in the Middle East are going to be watching for from the president's address tonight.
So I think that one of the main things, and we've had some reporting on this, is that what he's going to take to Congress and trying to get financial support for Israel. This is something he mentioned while he was here. Our reporting says $100 billion, not just for Israel, but for Ukraine, for the southern border of the United States, and a litany of other issues. So that will be certainly focused. But then the question is, what can he bring to these Arab leaders?
The president's remarks are scheduled for 8 p.m. Wall Street time. You can hear them live here on Bloomberg Radio. The House is set to vote again today on whether to elect Jim Jordan as its next speaker. Bloomberg Government Congress reporter Jack Fitzpatrick has more on what to expect from round 3.
There is now discussion about who comes next or what comes next. There's the option of using a resolution to give the acting Speaker Pro Tem, Patrick McHenry, more authority to allow legislation on the floor. So there is a possibility that some legislating can be done even without a clear answer on the speaker.
Bloomberg Government's Jack Fitzpatrick reports several other Republicans are also floating their names as candidates if Jordan goes down in today's 3rd round. Former Trump lawyer Sidney Powell has agreed to plead guilty to 6 misdemeanor conspiracy charges in the election interference case in Georgia, and she has agreed to cooperate fully with prosecutors. Donald Trump, meanwhile, leading President Biden in a head-to-head race in 5 of the 7 swing states. A Bloomberg News and Morning Consult poll shows Biden trailing Trump on the economy and foreign policy. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Yeah, I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages, they are mixed right now. Some individual earnings, those are the real standouts. Tesla reporting worse than expected earnings, and Elon Musk also is dialing back expectations. So shares of Tesla right now are 8% lower. And then you have Netflix climbing after posting its best quarter for subscriber growth in years. Netflix shares right now up about 16%. Now, the rout in the bond market, that keeps going on. The yield on the long bond above 5%. The data today, applications for unemployment benefits dropping last week to the lowest level since January. The labor market just keeps powering ahead. And meantime, Sonia Martin at DZ Bank watching the strong dollar for clues about where the economy is headed.
I think mainly the dollar really benefits from the view, increasingly widely held, that the U.S. is going to do not even a landing. It's just going to continue to fly.
Well, right now, the S&P 500, 12 points lower. That's down 0.3%, 4302 on the index. The Dow Jones Industrial Average down 145 points. And the NASDAQ 100, that's higher, up 11 points right now, up about 0.1%. And Red Lobster, consulting with outside advisors on their operations, the seafood chain looking to address its mounting losses. I didn't realize they've been in business for 55 years. They have gone through multiple owners in recent years. And there's some discussion as to whether or not, what they serve in the chunks is actually lobster.
Yeah.
It is a crustacean. We can confirm that. But it's like something they get out of Argentina. It's Langostino. I'm sure I'm mispronouncing.
Those are like really gigantic shrimps.
Yeah,
I think, right?
And it's a crustacean, but it's cheaper than lobster. You can get a real lobster. The only way to ensure that you're getting a real lobster is to, buy the whole thing at the Red Lobster.
Does anyone do it any other way? I mean, whenever I've ordered lobster in my life, I've ordered a lobster.
But you order the lobster bowl or whatever.
I never do
chunks
that.
of
no.
That's not really lobster, so they say.
Shipwreck restaurant in Brielle Monday nights, lobster night. We're there every Monday night.
Yeah, I love a good lobster. Sure. But I also love langoustines.
Okay. I didn't know what they were.
I'm happy to eat jumbo shrimp.
With oxymoron. All right, very good. Military intelligence. John Tucker, thank you so much for joining us. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker studio. What's a fixed income investor to do? 2022 was just the worst, maybe of all time, for fixed income investing. This year's, it's not much better. If you're in high yield
this year.
It's been bad. If you're in high yield, you've had some positive returns, but that's about it. So let's check in with somebody who does this investing stuff for a living. Mike Green, he's a portfolio manager and chief strategist at Simplify Asset Management. Mike, thanks so much for joining us here. How are you guys approaching this market here? I'd love to get kind of how you entered the year and maybe how you've kind of repositioned, if at all, here as we get into the fourth quarter.
Well, fortunately, at Simplify, we run a number of strategies. So we've had everything ranging from our interest rate hedge product, PFIX, which looks like it's on track for a second year of a row of just being a phenomenal performer. But simply, that's just betting against rates, right? It's betting on higher interest rates. It's worked as a fantastic portfolio hedge. In terms of my personal exposure in funds that I directly manage, I have been biased towards bonds and duration, and obviously that's been the wrong call for the year. I think the interesting question is why, in the face of much higher interest rates, are we not seeing equity markets respond? And I think the most interesting aspect of it is simply that we're not seeing flexing in demand. We're not seeing that marginal player who can say, I think equities are relatively unattractive versus bonds. We hear an awful lot about the very low equity risk premium, but we're not really seeing allocations change in a meaningful way. And that strikes me as one of the most interesting dynamics that's playing out in markets today. I think it plays into a bunch of the material and emphasis that I place on passive investment strategies, systematic investment strategies, where portfolio construction is not really tied to the underlying fundamentals. It's tied to historical return profiles.
Yeah, well, it seems like everybody, it seems like a lot of big names have been burned. You know, Stephen Major recently came out and said he was wrong on bonds. He pointed out that debts and deficits hadn't mattered in the past, and now they do. Lacey Hunt over at Hoisington Investment Management has said this is one of the toughest years of his career, and he's 81. So he's been in the market for a long time. And everybody is like, hey, inflation is coming down. In fact, there has been no decline this large in inflation that hasn't been involved with a recession and its immediate aftermath. So I guess I have two main questions, Mike. One, do you think inflation is really solved? Has the Fed, done it? And two, are we headed for a recession, or is Paul's soft landing scenario going to play out?
So I'm very much in the camp that says that the data is currently misleading us. I agree, by the way, that the inflation story has played out as many of the transitory inflationists, myself included, would have argued. We've seen a remarkable deceleration. If you go further within the inflation data series and you focus on market-based measures, and so just very quickly remember that about 35% of the CPI numbers that we see are what are called imputed measures. Those would include things like owner's equivalent rent, very slow moving adjustments that they make. Even really silly things like the cost of banking services is currently very elevated because of the way we define that, right? So crazily enough, the cost of banking services is defined by the spread between the risk-free rate and the rate that is being paid on deposits. That means that as the Fed has raised interest rates, they've dramatically increased the imputed costs of banking services. So those are the factors that are actually currently driving or keeping inflation elevated. If you use the market-based measures, the ones that you experience on a year-over-year basis as you go to the grocery store, those are now running below 2%, below Powell's targets, and would suggest that that's not the problem at all. I think the clear challenge that we're facing is modestly increased supply. Again, not a crazy increase. I understand people point to higher level of deficits, et cetera. We haven't seen an unbelievably large increase in the supply of bonds, but the bigger story continues to be the relative challenge of getting people to actually change their allocations and say, should we allocate to equities away from bonds? That's just a structurally very slow process.
What about, I saw a story this morning, China or Chinese investors have sold more U.S. holding stocks and bonds than they have in the past 4 years because they're defending the yuan. And a lot of countries are defending their currency against a stronger dollar. Do foreign investors who are huge holders of treasuries, are they a problem for this market?
Well, they're definitely not helping, right? Because we would hope to see an increase in demand. Now, the irony, of course, is that their source of supply, the reason that they've accumulated those are the very large trade surpluses that they run with the United States, and then their failure to reinvest in any meaningful way, which historically would have led to their currency appreciating. Now, as they face unattractive commodity prices, as they face a slowing in the Chinese economy, as they face capital flight from within their own economy, you're seeing them effectively have to defend their currencies against the rising U.S. dollar. Yes, they're no longer accumulating in the same manner, but we're not really seeing a wholesale crash, right? The tick type indicators for demand from foreign buyers are muted, but it's not a crash in demand. The other thing that I would just highlight is that we're seeing this is not a U.S. story. We're seeing bonds sell off on a global basis. And so we hear an awful lot about the unsustainability of U.S. fiscal policy. The simple reality is I look at a place like France, which is running almost the same deficit to GDP as the United States and doing so on a much more structural basis. And their bonds are actually trading inside the United States. That suggests to me there's a combination of diversification and very slow to respond demand.
Hey, Mike, thanks so much for joining us. Always appreciate getting a couple minutes of your time. That's Mike Green. He's a portfolio manager and chief strategist at Simplify Asset Management. He's been in the business a long time, has seen the various cycles here.
Used to run Peter Thiel's money.
Yeah, that's kind of cool.
Which is a lot of money. And we have an amazing story on the terminal today showing that of the 271 people Peter Thiel has bribed to drop out of college, he pays kids $100,000 to drop out of college, 11 have founded billion-dollar-plus businesses. Almost 12, because one guy just sold out with 975
Good for him.
million.
That's a good return on that investment. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, European regulators are putting pressure on social media companies to stem the flow of harmful material. Bloomberg's Steve Potus reports.
The European Commission says it sent formal requests to TikTok and Meta to explain what they're doing to stop illegal content from spreading on their platforms. The Commission last week sent a similar request to X owner Elon Musk. Regulators are concerned about the flow of disinformation and illegal content amid the war between Israel and Hamas. The EU's Digital Services Act requires social media companies to hire more content moderators and use risk mitigation methods to slow the spread of harmful content. Steve?
Thank you, Steve. Officials at Meta and X say they are complying with the EU regulations. AT&T has a reversal of fortune after a string of quarterly losses. More from Bloomberg's Gina Cervetti.
AT&T is making progress in boosting subscriber numbers. The company added 468,000 mobile customers in the third quarter. That reversed 4 straight quarters of declining subscription growth and beat estimates. Apple's new iPhone 15 was released toward the end of September, and the effects of those deals won't be seen until the fourth quarter.
Thanks, Gina. Shares of AT&T up more than 7.5%. Starbucks and the union representing baristas are suing each other in a trademark standoff. The coffee chain wants the union to stop using a circular green logo that looks like its own. Starbucks United in a countersuit is asking a federal judge to let them continue using it. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets here, we got the S&P 500 off about 0.3%. The Nasdaq kind of unched on the day, a smidge on the red side. Calling out the VIX for Tom Keene. It is almost, we're just under 20. So that's notable for folks that take a look at the equity volatility out there in the rate space. 10-year Treasury is up 3 basis points, 4.94%. You got 5.02 on your 30-year. How about that? There's no reinvestment risk there. Crude oil is off about 0.6%, $87.73 there on WTI crude oil. Right now, let's head down to Washington, D.C. Amy Morris has got world and national news for us.
All right, thank you, Paul. A potentially significant development in one of the criminal cases against former President Trump. Sidney Powell, the former Trump lawyer who is one of 18 co-defendants in the Georgia election interference trial, has agreed to plead guilty to 6 misdemeanor charges.
Do you understand that by pleading guilty, you are giving up the right to a trial by jury? Yes. Do you understand that by pleading guilty, you're giving up the right to remain silent and not to incriminate yourself? Yes.
Sidney Powell has also agreed to cooperate fully with prosecutors. The deal came just a day before her trial was to begin. Undocumented immigrants are allowed to live in the United States for years while their cases play out in the court system. A plan to give judges more independence to deal with the backlog is being opposed by Republicans who feel the focus should be on border security.
Millions of people in line waiting for a hearing in an immigration court, clogging the courts when only 15, maybe 20% can qualify.
Senator John Cornyn of Texas wants to stop the ballooning backlog by forcing migrants to apply for asylum in Mexico first. Currently, there are more than 2.5 million immigration cases pending in American courts. Some have to wait nearly 10 years to get a ruling on their claim for asylum. More layoffs are announced as the United Auto Workers strike against the Big Three drags on.
Ford says it's laying off another 150 workers in Michigan because of the ongoing UAW strike. That brings the company's total of workers furloughed to 2,730. Ford says the UAW's walkout last week at its Kentucky truck plant prompted the new layoffs at a Michigan axle plant. The targeted strike against Ford, General Motors, and Chrysler parent Stellantis began September 15th. Scott Carr, Bloomberg Radio.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Matt.
All right, Amy Morris, thank you so much. We appreciate it. All right, Matt, if you want a used jet, you're going to have to pay up for it. 2 out-of-production Airbus and Boeing jet series have become hot commodities with plane values and monthly lease rates soaring for airlines fortunate enough to procure the aircraft. Apparently, airlines are starved for planes.
Oh, yeah.
Partly owing to supply chain kinks still rippling through the COVID-19 pandemic. These continue to hold back new aircraft production, while an even more disruptive issue with popular Pratt & Whitney engines requires time-consuming rework, sidelining younger A320s and worsening repair shop backups across the globe. So if you want a jet, Matt, I don't know. I'm not sure what we can do for you here.
I mean, I want a jet, right? But I want like G6 or something.
Oh, okay. You're not going
right?
like...
If this story is just about airlines, the big commercial airlines, and the 2 jets that are most in demand are 2 of, in my opinion, as a commercial traveler, the worst jets out there, right? A 737, the Boeing 737 NG.
Yep.
And frankly, I don't want to be flying on anything with the number 737 in it. And then there's the A320.
That's the workhorse, dude.
I know, but these, these are the single aisle. Yep. And by the way, in my 49 years on this planet, the aisle has gotten slimmer and slimmer and slimmer.
Oh, I know.
Like normal Americans cannot fit through the aisle of a single aisle jet these
maybe
days.
with Ozempic, things will get better.
Yeah, well, dude, that's no joke. Analysts are really looking at airlines. They're going to have lower
They're going to burn
payloads.
less fuel with people who are thinner.
You know it.
That's going to hit the bottom
You know,
line.
and we're going to be able to finally fit through the aisle of an A320.
Right.
When I'm flying commercial, like it's bad enough as it is, and I know that
6'4", right?
I know that commercial airlines are trying to make the experience as bad for customers as humanly possible.
Yep.
But I want to fly on like a 747-800,
which they don't make anymore.
or a 787
Love that.
Dreamliner.
Love that bird.
Yeah.
Yep. So, all right, but most of us here, certainly in the continental U.S., 737, A320s, they're in hot demand as more and more people hit the skies. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to have a roundtable here. We're talking about some earnings. Dan Ives, senior equity analyst at Wedbush Securities, joins us to discuss Tesla earnings and other tech news. And also Geetha Ranganathan, she is a Bloomberg Intelligence media analyst. We're going to discuss Netflix, ESPN. Actually, ESPN is actually, for the first time ever, the Walt Disney Company is breaking out financial results for ESPN, so we'll get the lowdown there. They make a lot of money at ESPN, just not as much as they used to. Billy House is going to join us. He's a congressional reporter with Bloomberg News. He's going to give us the latest reporting. Is there any headway on our good friends and our esteemed leaders in Washington, D.C., maybe electing a Speaker of the House at any point soon? But first, let's kick things off this hour with John Tucker and a Bloomberg Business Flash.
I'm Paul. Stocks mixed. Treasuries trimming some of the losses as the 30-year bond tops 5% yield in the NASDAQ 100. This is a tale of two earnings. Netflix, the leader in the NASDAQ 100 there. Tesla is the big laggard after their earnings reports. Netflix shares up 15%. Tesla shares down 8%. Well, as rates continue to rise, Jeff Yu at the Bank of New York Mellon says, you know what, consumers in the economy will be feeling the pain.
Well, when you actually have real yields, push through, 1 percentage point, 2 percentage points, for a developed economy, I think that's where the pain really starts to come through, because then you really start to struggle to make the case for real income growth.
And applications for U.S. unemployment benefits dropping to the lowest level since January. On the data front, also sales of previously owned U.S. homes falling in September to the lowest level since 2010 as affordability worsened even further. The S&P 500 10 points lower. That's down 0.2%. 4304 on the index. The Dow down 107 points. The NASDAQ 100 still in the green, up 6 points right now. The 30-year yield 5.01%. That is up 2 basis points. You see the story in the Journal? The bar for taking a sick day getting lower, apparently. Yeah. The Journal reports younger employees feel more entitled to take full advantage of the benefits that they've been given. But is that good? Yeah, you get a benefit of sick days, but you're not just, you take them when you're sick. It's not like they're vacation
Well, there's
days.
two. So there's sick days and there's personal days, right? Most civil, humane companies will give employees a few P days, where if something pops up, like say you've got to get to the nursing home to deal with your elderly father, you can take a P day, which you hadn't planned for. But you have to do that sort of thing. You can't run life without taking the occasional P day, right?
Is it safe to say that we want Matt as our boss at some point in our careers here?
Absolutely.
The other thing is,
just as long as he makes decisions pertaining to us and not for the overall strategy of the company.
No, for the whole. I'm from the age of. So that's one thing where just people have to do stuff, right? If your childcare isn't there that day, sometimes there's nothing you can do. But the other thing is the sick days, because I'm from the same age as Paul, essentially, and you, where it's Wall Street. You come in. It doesn't matter if you have a cold. But the problem with that is you come in with your cold thinking you're some kind of hero, right? And you get the whole desk sick. And then a couple weeks later, your whole desk is out instead of the one dude who should have just stayed home.
That's where we are right
now.
This is the
Matt when he had COVID, right?
Yeah, exactly. All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so go over and check that out. A little roundtable here on some earnings. Dan Ives, senior equity analyst at Wedbush Securities. He joins us live here in his Bloomberg Interactive Broker Studio. I'm not sure if he's going to State College this weekend. Not sure about that. Or are they at Ohio State?
Yeah, we'll be going to Columbus Friday night.
Oh, you're going to Columbus? Yeah.
Awesome.
Oh, nice.
Very good.
I got a bar for you. There, you go in there, order whatever you want, food and drink. If Penn State wins, they will pick up the tab. I'm going to hook you up.
All right, Geetha Ranganathan, she's definitely not going to Columbus, Ohio, because she's a professional. She covers the media sector for Bloomberg Intelligence, and we want to talk about Netflix and ESPN. Dan Ives, let's start with you. Tesla stock not liking what they're hearing from Elon Musk. What was your takeaway from the quarter for Tesla?
Look, it was a disaster conference call. I mean, because it was the street wanted to hear about pricing, have the price cuts ended, what is the outlook like going forward? Instead, this was really Musk being more of an economist, obviously much more somber. And I think investors leave with just more questions and answers in terms of this price war that, we've talked about here a lot. How long does it continue? And obviously on Cybertruck, that's going to be a huge vehicle relative to demand, but definitely going to be an uphill battle from a production perspective.
So I got a million questions after that conference call. But my first one is on the Cybertruck. He contends that this is like a special project and that makes it extra difficult to produce. Why is that? Why isn't it just a normal truck? I mean, this could be like an F-150 competitor. It's so cool. Everybody wants it. So many people put in pre-orders. Why is it so hard to make?
Yeah, from an engineering perspective, it's very difficult. So that's one, no one argues
because it's a special shape?
Because of the shape, because of the materials in there, as well as what they're trying to do from a technology perspective. That's why you talk about getting mass production. Look, that's essentially why they built out Austin in terms of Giga. But I do think Musk caution, of course, not the demand side, but the production. And to Matt's point, look, that's always been the issue with Tesla. It's not about the demand story, it's about the production. Ironically now, for the first time, demand sort of hit equilibrium when it comes to supply.
All right, so we've got Tesla down about 8-9%. On the other side, we got Netflix up 15%, monster quarter. Geetha, what did you hear on the conference call last night? What did investors hear on the conference call last night that got them all hot and lathered here for Netflix?
Yeah, absolutely. I mean, it was a blockbuster quarter on all fronts, Paul. So absolutely, the beat was not just a beat, it was the magnitude of the beat. And the story, the narrative is really clean now. It's getting much, much clearer, as far as the margin trajectory is concerned. They promised about 22-23% margins going out in 2024. They promised, subscriber momentum kind of extending into 2024. So really kind of firing on all cylinders, if you will.
So, Geetha, it seems like, you follow the whole media space. It seems like Tesla's really pulling away from everybody else.
You mean Netflix, right?
Netflix, thank you. That Netflix is just pulling away from all the competitors, maybe including Disney.
Oh, absolutely. There's no doubt about it. We already know that Netflix is way ahead of its rivals, not only when it comes to subscriber scale, but also in terms of profitability. Remember, this is the only company that is generating profits today, Paul, on its streaming business. The rest of the space, this company is going to generate about $7-8 billion in profits this year. The rest of the space, including Disney, Warner Brothers, Paramount, all of them collectively will throw out about $8 to $9 billion in streaming losses. So obviously, when it comes to profitability, when it comes to operating leverage, there is no doubt that Netflix is the clear winner. They are the dominant player. But what was the biggest surprise was the fact that they're just throwing out tons of free cash flow. So this was, a stock that we used to kind of almost mock and ridicule, talking about, $3.5 billion in cash burn. This year, they're putting out $6.5 billion of free cash flow. So this is, this is a free cash flow machine. And not just that, they committed to $10 billion in buyback. So as you kind of look, at them shrinking that float, look at EPS growth. I mean, it's going to be in the 30% range for the next few years. And that is really huge in kind of this media landscape right now.
I mean, my takeaway from our Screen Time conference last week was that Netflix is the boss of everything. I mean, if I were buying stocks, I would have loaded up after I saw, did you watch Harry Styles interviewing Ted Sarandos? I mean, Lucas Shaw interviewing Ted Sarandos last week. I thought that guy came off like an absolute boss. They're doing everything right.
They are. Look, and I think the thing here, it's all not just about content. You think about the competition, what was coming from Disney. They've now taken a step back, and you look at that conference, that was a flex the muscles, especially when you look at free cash flow. If you look at Netflix versus Tesla, just to take those to last night, it's not necessarily about the result. It's also, if you look at the communication, the street wants to understand what the path looks like in a very uncertain, cloudy market.
Geetha, what's the headwind? What's the biggest risk for TED and Flix?
Right now, they seem to be getting everything right. So the one concern I think that kind of is still kind of lingering a little bit is this whole revenue growth reacceleration. I mean, they've got all the levers in place, but ARPU has been under pressure a little bit. We saw ARPU decline a little bit in the third quarter.
ARPU is average revenue per user.
Revenue
Look
per
at you.
Yes, average revenue per user. So that has become like the really big metric now to kind of gauge the success in the streaming world. They did, of course, caution to that. They said it's going to be a little bit flat. But then again, we have price increases that are going into effect. We have the ad business that's going to take off. So as we kind of look to 2024, everything is in place for that metric to kind of ramp up pretty significantly as well. So right now they're getting everything right.
Hey, Dan, my big question on EVs in general, and I just purchased a new vehicle.
We're going back to Tesla now.
We're going back to Tesla.
It's kind of hard to keep track.
Well, that's why.
These are two very different companies.
I know, but they're both ripping stocks. These are the ones that are most read
Tesla's
all the
getting
time.
killed today, right? Netflix is up 15%.
Yep.
Tesla is down 8.7.
But for me, the big issue, having just purchased a new car, BMW X3.
He loves the X3.
Love the X3. Although I have like 12 miles on it. I'm just walking back and forth to the train every day. Is end demand. I really have questions about what is the real demand out there in America for EVs. Like, I'm thinking
beyond the rich, beyond like a second or third car,
like,
right?
Is there a political angle here? Like, I think half the country will never buy an EV.
Look, I mean, you're starting to get into a debate around what the demand curve looks like. But ultimately, price is so important. If you go back to traditionally Tesla, 75, 80, 85,000. Now, even with the tax credits, 35, 40,000, depending on what state you live in. But it does also, you talk about the battle from the Beltway and what's happening here, even with UAW and what's happening in Detroit with GM and Ford, it's all price driven. 3% of automobiles in the U.S. are EVs today. So we believe that goes 10, 12%. There's going to be massive winners, but it also comes down to price, especially in this macro.
I mean, as long as President Biden is going to pay me, he's going to borrow money from my kids and my grandkids to pay me to buy an EV. I'm interested, but I want the Cybertruck. That's the one I want.
Exactly. And Miller's going to have the Cybertruck while watching Netflix in full self-driving in 3-4 years.
Hey, Geetha, another big day in the world of media yesterday or in the past couple of days, Disney, for the first time ever, released financial results for ESPN. And my takeaway was two things. One, their profit margins there's still a lot of cash flow, almost $3 billion of EBITDA, but it declined big time, and it's nowhere near the number it used to be. What is ESPN, or what is Walt Disney Company going to do with ESPN?
Yeah, that's the big question, Paul. And I mean, one of the reasons that they kind of broke this out as a standalone unit was because they really kind of wanted to show, potentially future investors, if they're planning to sell a stake or if they're planning to spin it off, what the financials kind of look like. But obviously, the top line actually looks pretty stable at $16 billion. It's really the profit margins, as you rightly pointed out. I mean, you look at the traditional cable business, it's about 30-35% margins. You look at ESPN's margins, it's 15% this year. So that is a little bit concerning. And obviously, it is only going to go lower given that, sports rights fees are increasing astronomically. So they really need to do something with this asset. We know that they need to do it fast. The question is, do they sell it? Do they actually sell it to Apple, as has kind of been said all, or do they, spin it out? Again, we'll have to wait and watch. But they are definitely good.
I kind of feel like I have to apologize to Geetha because the 25 years I had covering the media industry were the golden years. Everybody made money. What I've left to Geetha is just a hodgepodge. I don't know what's going on out there, Geetha. Can you get any investor out there to say, I want to overweight media?
No, not at all. Everything is down in the dumps right now, other than, of course, Netflix. But we'll have to wait and watch what happens with Disney. I think they have a great collection of assets. They're trying to do everything that they can, but Bob Iger obviously has a lot of challenges ahead of him.
Including naming a successor, maybe.
It seems like that is one of his worries, but others are just as pressing. I'll be interested to see if the leagues come in and get a piece of ESPN. Is that still on the table? Dan, what do you think? Could like the NFL and some other professional sports leagues come in and take a big chunk of it?
Look, we believe this is ultimately going to lead Apple to acquiring ESPN.
Oh, you think Apple? It's all Apple.
Our Our thesis has been, Laura's talked about.
Laura says all of Disney.
No, so Laura talks about Disney, which, obviously makes sense there too. But we believe it's really about ESPN, the live streaming asset. If you look what happened with MLS and Messi, I think they recognize in terms of Cook and Cupertino, even though M&A is obviously not their sweet spot, ESPN's a unique asset.
It'll be a better buy than Beats, right?
And that was $3.5 billion.
How much is ESPN going to cost?
I mean, we think 40 to 45 billion is probably what would be the price tag.
Nice.
But then when you look at Disney, it's this conversation talking about some of the parts. You sell Disney, and that's why there's more and more pressure on Iger and the board.
What's Disney worth? Like 150? Let me pull it up.
DIS.
Yep.
Disney is currently, in market cap terms, worth 153.7 billion.
And we think about a third of that value.
So if they get rid of, let's say they get $50 billion for ESPN. Geetha, what is Disney then worth if they sell ESPN for $50 billion?
That is actually a really, really high multiple. So, if you kind of look where cable stocks are trading right now, they're trading at about 7.5 times EBITDA. At 7.5 times EBITDA, ESPN would be worth about anywhere from about 22 to 25 billion. So it'll be interesting. It'll be interesting if they can get that 15x multiple. That would actually be awesome. But again, you have to kind of look at Disney's, really bread and butter of the business. That is the parks business. That is going to, just a few years ago, parks used to bring in only about 35% of operating income. This year, it's bringing in about 75% of operating income at $10 billion.
Yep.
So, Disney really is parks right now. And parks itself should be worth, I think, 200 billion.
Nice.
I just want Dan finally get back to Tesla in terms of production and the Gigafactory. There was a lot of talk on the call yesterday about whether Musk could do a lot of his production in Texas. Where are they going to build the most of their, expansion, or does their expansion not look as fruitful as it did, before this call?
Expansion's going to be in Austin, broader Texas, as well as in China. I mean, they're focusing more and more away from California, obviously their core
and away from Monterey.
Away from Monterey, yeah. And look, and fundamentally just speaks to mathematically, economically speaking, it's Texas. You talk about the Mexico plan that they're going to, ultimately start to build out, but it's really China. Capacity right now is not the issue. It's about the price cuts. Keep cutting prices. That's a bad spiral.
Yep. All right, Dan Ives, senior analyst at Wedbush Securities, covering all that fun stuff in tech, and Geetha Ranganathan. She is the media analyst at Bloomberg Intelligence based down in Princeton. And Dan, heading off to Columbus, Ohio, to see undefeated Penn State
of Ohio
take on undefeated Ohio State University.
Ohio State.
Huge.
And look, I think it's going to be a battle. It's going to be a great game. I think Penn State comes out of the shoe with a W.
Nice. There you go.
I mean, I have no idea about sports.
We'll put a couple
squash and
down
sailing,
on your Ohio State.
I'm in for Ohio State. Let's put $20 on it.
All right, here we go.
Deal.
This is Bloomberg. Let's get company news right now with Steve Rappaport.
Paul, it's a great day for Netflix shareholders, with the stock gaining the most since January 2021 after the company boasted its best quarter for subscriber growth in years. The company credits a strong programming slate and its crackdown on password sharing for the increase. Netflix revealed it added 8.76 million customers in the third quarter, way exceeding analysts' forecast and boosting the overall subscriber base to 247.2 million. Netflix is now planning to raise prices for some customers in the U.S., U.K., and France. Shares of Tesla are down after Elon Musk tried to temper expectations for the next quarter. Bloomberg's Ed Ludlow has more.
The story is that it is a difficult environment out there, and if you look at the sell side or analyst response, a number of firms have cut price targets, and of course now starts the reevaluation for forecasts for 2024. But the read across between them is that expectations going into this quarter for Tesla were low, what came out in terms of financial results in the quarter gone was even lower than those low expectations. Adjusted EPS, 66 cents a share. The forecast was 74 cents. The story of the year has been price cuts, and we've seen how that's impacted the bottom line.
Thanks, Ed. Tesla stock now down more than 9.5%. Nokia says it will cut as many as 14,000 jobs, roughly 16% of its workforce. The move is expected to save the company as much as $421 million. Makers of 5G equipment are struggling as clients in the U.S. and EU cut capital spending after building out their networks. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.